Yes, you read it correctly. This will be a 5-hour fully in-depth course going over everything from how the financial markets work, what the fundamentals of trading is, to how time and price works in the markets. And then you will learn a step-by-step approach on your trading so you can know exactly what to do with the information you get on a daily basis. This will be the only video you need in order to understand all the concepts before you start trading on your own. I was where you are many years ago. I went from strategy to strategy and eventually had information overload because I watched YouTube video after YouTube video, and this wasted months, if not even years, of my trading development. So in this video, we'll cover all you need so you don't have to waste the time just like I did. If it's your first time meeting me, I'm Daniel. I started my trading journey at 15 years old, and it took me 4 years until I had my first ever profitable month. And now I help traders achieve consistency in trading and get to their first payout. What you will learn today is the exact same process that I helped Alex with, one of my one-to-one students. He went from knowing only the fundamentals of trading to just 5 months later getting his first ever payout, and now he's trading multiple 6 figures in funding. Or Jacob, who started from literally zero. He didn't even know what a candlestick was. And now 6 months later, he got his first ever payout of $2,000. And before we get started, in this video, I will cover all the concepts and information, the theory that you need to know. But you will still have to put in the hours, put in the work yourself, studying everything I tell you, go and backtest and look at it yourself. That's how everything will fall into place and how you will actually learn what I will tell you. So let's get into it. Alright, let's get right into it. And in this video, it will be divided into 5 main chapters. And as you can see right here, we have the fundamentals of trading that we'll start off with. What is trading? What are the financial markets? And what are the core concepts and ideas you have to understand before we get into the more advanced topics. Then we'll talk about the topic and the part of time in trading. Then we'll go over into price. And then at chapter 4, we'll put everything together. How do we go about our whole trading approach? And the 5th and final chapter will be about what you should do after watching this course. So let's get into it. And in this video, you can expect how to go from zero to understanding exactly how to operate your whole trading on a daily basis. We'll go into deep dives of all the technical analysis, the concepts that you need to know, the full step-by-step protocol on how to actually use this information. So first we'll go over the whole theory and then we'll apply it into a full structured plan. And you can also expect my best effort in teaching this the best that I can. My goal is that after this video, you'll be able to start your own trading journey and get right into trading. And I expect you to be fully focused when you're listening. I recommend that you take pauses every 60 to 90 minutes so you can actually listen and be focused when you're listening. Because this will be a long video and there will be a lot of information to comprehend and to note down. So I want you to take pauses so you can be sharp. And I want you to, of course, take notes. And then I also want you to pause the video and actually do the exercises that I will tell you to do. I will have a lot of exercises in each chapter that I want you to do. I will tell you when they are. So stop the video when I tell you to. Do what I tell you to. That's the best way you will learn. And then I also want you to be kind to yourself, because you might not understand everything that we talk about immediately, and I don't think you will. But don't be harsh to yourself just because of that. If there's one concept you don't understand, go back and re-listen. We're all different, and the way I teach might not be the best way that you learn. And the final thing I demand from you is doing the homework that I will tell you to do by the end of each chapter. Either you do it after each chapter, so you pause the video and come back, or you go watch the whole video and then you do all the homeworks. So the first part is the introduction to financial markets, because the financial markets is a place where actors get together and speculate in different assets. It could be stocks, it could be bonds, it could be currencies, it could be way more things. I want you to view the financial markets as a big marketplace where you can buy and sell your own things. The only thing is that you are selling the assets that I mentioned above. You can sell your assets to someone who buys them, and you can buy assets from someone who wants to sell it at your price. And one of the main assets that we will focus on today, and all the teachings and examples that I will show today will be about, is the index futures. From now on, I will only show examples and mainly focus on the index futures. And when we talk index futures, the main assets are NASDAQ, so NQ, and the S&P 500, which stands for ES. And some general information about these is that 1 point on NQ, which is 4 ticks, equals $20. 1 point on MNQ, which is the micro contract, equals $2. 1 point on ES, which is 4 ticks, equals $50. And 1 point on the micro ES equals $5. So all the examples will be with these two markets. Now the first concept and the first thing we need to understand is the fundamentals, the way we are trading, which is called smart money concepts. We have two different types of actors. We have the smart money to the left, and we have the uninformed retail money to the right. Now the smart money consists of hedge funds, banks, and wealthy families. These are the players that are running the markets. The markets are not driven by buying and selling pressure, which I'll get to in a minute. And to the right here, we have the uninformed money. These are the retail traders and the average trader. These are the type of traders that smart money targets and traps. Now, why do we need to understand this? Well, we have to understand that financial markets are not driven by buying and selling pressure. Because I want you to envision something. The financial market is a $10 trillion a day business. That's how much money that is flooding every single day in these markets. Do you think that the people who are running the world, the big players, these big families and wealthy type of institutions would let people like you and me have control over the markets? I don't think so. So we have to keep this in mind, and all the future things we'll talk about today will be based upon this concept and this fundamental truth. And as I said, buying and selling pressure is not how the financial markets move. Smart money is in control of every single move. This is done by centralized algorithms that move the markets. And you might think, okay, Daniel, what do you mean? These people have been driving and determined where the markets will go for centuries. Before even technology was out there, they were doing it manually. So the only thing I want you to keep in mind is that nothing in these markets are random. Now let's get into the first topic here and the first actual technical analysis part. And this is candlesticks. I'm sure that you have seen a candlestick before. Now what does a candlestick represent? Each candlestick represents a specific time frame, and then it represents the price within that time. So as you can see right here to the left, we have a green candle. This is a bullish candle. And to the right, we have a bearish candle, the red one. As you can see, we have written down 4 different words. We have open, we have low, we have close, we have high on both markets. But what you can see if you pay attention is that open and close is on opposite ends on the green, so the bullish and the bearish candle. Why? Keep in mind, we said that a candle represent the price movement for a specific time frame. Okay? This means that every single time frame, every single candlestick has an opening price. Let's say that we are looking at an hourly candle. This means that every hour we have a new hourly candle that opens up. So it starts off, it opens, and then if it's a bullish candle, we will open, we will go lower, which is represented by this wick. We'll go higher, which is represented of this other side, the other wick. So the highest point of this time cycle or this time period. And then eventually we will close somewhere here. So this is a open, low, high, close. Now I want you to keep this wording in mind, because this is something we'll talk about a lot. And on the other end, on the bearish example, it will open up, go higher, making the highest point for this time period, go lower, make the low for this time period, and close somewhere here. So we can see these 4 points: the opening price, the close price, the absolute high of this period, the absolute low of this period. Now, if this sounds confusing, and I understand it might do, candlesticks can be any single time frame that you can think of. It can be a seconds chart, it can be a minute candle, it can be hourly candle, daily, monthly, yearly. The only thing we are using this is to frame our analysis, is to have something for us humans to actually look at a chart, for us to see patterns, see movements, because time and price is the only thing the market is driven by. So we need to have something to interpret it from our perspective, right? So this will be way clearer the further we go down the line. What I need you to understand is that we can have multiple different time frames, and every single time frame is represented by a candlestick. And then we have the open, low, high, close. For a bullish example, we have the open, high, low, close for a bearish example. So now when we understand what a candlestick is, we need to understand how the market is moving. Because the markets can only do two things. It can go higher and it can go lower. That's the only single thing the market does. It either goes up or it goes down. Very simple, right? Now, how do we actually define this? Well, first of all, we have to remember or learn the word market structure. This is how we define up and down. And as you can see, I've written a few things down here. Bullish, which means up, the green one, always makes higher highs and higher lows. Bearish, meaning this red one, always makes lower lows and lower highs. Now, what do we make higher highs, higher lows compared to? We always compare it to the previous high or low. So let's look at this example here. Right here, we can see that we start here from 0. We make a high right here, which is marked by HH, higher high. We then retrace and continue a bit lower, making a higher low compared to the previous low right here. And now the market goes higher again. And right now we make a higher high compared to the previous high. So we always refer to the previous high and low to determine if we make it higher or lower. And now we retrace again. And what do we see happen now? We make a higher low compared to the previous low right there. And this is how the market continues until we switch from bullish to bearish. Now, this switch, this change of structure, is called CSD, which we'll cover more in depth later down the line. But I want you to just remember change in the state of delivery or change of structure, which is the name of CSD. So that's when we go from bullish to bearish or bearish to bullish. And what does that mean? Well, we go from making higher highs and higher lows to making lower lows and lower highs. So I hope you understand what the principle of market structure is, how it works, what it actually means, and how we look at it, right? Because what you'll notice in a few hours when you look back at this is that everything we do when we're trading is look at market structure. We look to anticipate where these reversal points on the upside and on the downside, upside and downside, will form so we can participate in it. That's the only thing we do as traders. And I've written a final thing here, which is that the markets are fractal. What does this mean? Well, fractality means that what we see on, let's say, a specific time frame, if we go down a time frame, we will be able to see the exact same thing. Let's say that we are looking right now on this green line. We see the higher highs, higher lows, higher highs, higher lows, and so on. What I want you to understand, and this is the nature of fractality, is that if we zoom in to a small swing or to a small line, so from this low to this high, and we zoom into it, we drop one or two time frames, what we will see is this whole higher highs, higher lows inside this small line. And why is this important to understand? Well, because fractality is how we look at the whole picture. What we eventually do in a very simple manner is we look at the biggest possible time frame and we go to the smallest possible time frame. And what we'll find is that the best trades, the best environment to trade in is when all of these time frames tell the exact same story. When every single person, just imagine, what are the best stories? What are the most truthful stories to hear from someone? It's if the first, the second, the third, the fourth, the fifth person you speak to all tell the same story. Then you can most likely trust that that story is valid and true. It's the exact same in the market. We want to have every single time frame that we are monitoring, that we're looking at, which we'll go over, of course, later. We want all of them to tell the same story. So before we go into the next image, which will start to actually look and train our eyes on seeing market structure, I want you to just remember that bullish equals higher highs and higher lows. That's the objective definition of higher prices, uptrend, bullish is. And the same goes for bearish. So a lower trend, a downtrend, bearish, whatever you want to call it, is objectively defined by lower lows and lower highs. And we always look at the previous low or high when we make the assumption or when we make the saying of if it's higher or lower. And we'll get to that in the next one because you'll start to see that sometimes it's a bit tricky. So let's get right into it. So here's the first example. What we can see is this is a real chart that we have in front of us. We have a lot of price, a lot of movement up and down, all over here with a lot of different market structure. And this is how a real chart looks. Now what I want you to do, because this will be an exercise, I want you to pause this video, but before you do, pause it. Ideally, if you can, take a screenshot of this exact chart, of this screen that you see right now. And then I want you to use the drawing tool and I want you to just draw lines from the high to the low, high to the low, high to the low. Just follow the trend, okay? That is the first part. And then I want you to write down if you make higher highs or higher lows at any swing that you write out. So if you go back to the previous chart, I want you to eventually draw a similar schematic like this. I want you to make the highs, the lows, the highs, the lows, and label them. So wherever you see a higher high, you write HH. Wherever you see a higher low, you write HL. Lower low, LL. Lower high, LH. So pause this video now and let's get into it. If you haven't paused yet, do so now. This is your last chance. I will now switch charts. And there we go. So this is how this example looks. Now, what can we see here? We can see that I've drawn with a red line the market structure. If we go back here, I've drawn these highs and these lows right here. So we see, first of all, we start off right here with a higher high. So we have been going higher here. I didn't make it red right there, but you can see higher. We make a lower low compared to this low. Now we make a lower high compared to what? Compared to this one. And then we make a new low. And this is a new lower low. Why? Because we make a lower low compared to the previous low, which is right there. Now something interesting happens. We make a big move higher and we make a higher high compared to what move? Well, compared to the previous high that set up the low. That is important to understand. And what has happened here? If we go back to this, the switch from bullish to bearish or from bearish to bullish is called CST. So right here, from this high to this candle right here, if we would draw a straight line, we can see that we have gotten CST. We have gone from bearish to bullish. And now what we see is that the market continues making it continues to make higher lows, higher highs, higher lows, higher high, low, high, low, high. Now before we check what happens here, I want you to pay attention to something here, because this is the beauty of market structure. And this is something that will connect the dot later. But what you need to remember, and what I want you to understand, is that when you are in a bullish environment, we can anticipate things. We can start to anticipate where and when things will form, why they will form. Because as you see right here, we make a higher high, we make a new low, a higher low, right? We make a new higher high, and then we make a higher low compared to this low. Now, but the beauty here is that, let's say you are looking at this chart live, you might say, oh shit, we're going lower, right? But the beauty here is, if we know that we're in a bullish market, we will never take out this low. This is what I want you to understand. Same goes here. We make a new high and we keep going lower, 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 but we never take out the previous low. So we make a higher low. We make a new higher high. So this is now our previous reference point, and this is our new current high. We retrace again, and we now make a new high. So this is the beauty of understanding market structure, the way the markets move, because we can anticipate where things will form, know where it won't go, and know where it will go. So now if you did this exercise, I'm sure that these few highs and lows were a bit tricky to you. And as you can see, I've written question marks here, and I'll go over exactly why. But what we see is that we make smaller lows, smaller highs, smaller lows, smaller highs. And here I've written a lower low, lower high, lower low, lower high. Why? Well, two things. First of all, I'll explain the overlay picture, right? The lower low comes in here because we take out, or we make a lower low compared to the previous referenced low, which is this one. Why? Because this is the low, the high, and this is then the last low, the most recent low before the high. We break it right here, and this would be our CST level, and here we now turn bearish. And what are these question marks? If you remember right here, I said that the markets are fractal. I said that we could zoom in to any of these lines, the down lines, the retracements, the expansions. The expansions, the retracements, we can zoom into them and find the exact same picture that we are looking at now. So if we look at this example again, what we see is that we have made a high. Here we make a low, a lower high, a lower low, lower high in this bigger line. So if we look at the bigger picture, this whole one that I've written out, we see that this would be one line and this would be one line. Now, if we zoom into this line, we can see that there are tiny, tiny ups and downs within it, right here. And that means that this low would break the structure of this previous higher low. Do you understand? So we have we have a fractal CST, an earlier CST right there, confirming to us that we are eventually gonna draw somewhere here. And then when we get the low below this previous low, we get the lower low in the bigger picture. So this is how we can add pieces together. And this is what we'll go over more in depth later. But I want you to understand that this is how the markets work. The bigger picture looks the same on the smaller picture. So sometimes what I'm sure you'll start to think eventually when you look at that chart, you'll be a bit confused because you don't know which story is telling what. But again, what did I tell you? We want all the stories to tell the same thing. We want every person to tell the same story. That's when we know that we're in sync with the markets. And we'll get to this later. Let's look at another example. Again, here we have a real chart example, and I want you to pause this. The exact same exercise. If you can, take a screenshot, write with a pen or with an arrow tool, whatever you can use, write down the labels, and pause now. Now, if you didn't pause, I'll give you one more chance because now I'll go over to the real example. There we go. First of all, double check how your chart was looking or is looking compared to this chart. Is it correct? Is it not? Why not? Try and think first of all for a few seconds. And if you need to, just pause the video, compare them and see which one is right, which one is wrong. What did you understand? What did you not? I hope you paused and checked the differences with your one and my one. So let's now walk through the whole price action. Because what we see is we start right here on the far left. We have been going higher, and this is a higher high compared to this high. This is a small low that's forming, make a higher high, then we see a drop lower, forming a lower low compared to this low. Now I didn't mark this out, but I think you can see it. Then we see a new high form. Again, we have a question mark. We'll get to that in a second. Make a new low, a new question mark. And here is the first higher high after this high. Now, why? We make a high, low. So the most recent high before the low is this one, which is why we refer to that one. And we don't make a higher high here or mark this as a lower high yet. So at this candle, we are breaking structure. We make CST. We go from bearish to bullish. And here we make the first high. Then we make a higher low right there. And when does this higher low, by the way, get confirmed? Unless you haven't figured that out yet, and I hope you have at least had the thought in your mind, this low gets confirmed the moment we make CST to the upside, or the moment we close above the previous high. That confirms that this was indeed a swing low. Because what I want you to understand is that if you look at this live, we don't yet know until in a few hours when we'll cover this, but we don't yet know if this is a low or not. Let's say we look at it here. This candle closes higher. This next one closes higher again, but then we go lower again. So the low gets confirmed the moment we close above this high. And we then make a higher high, and now we see a big drop lower, making a lower low compared to what? I'll give you a second. Compared to the previous low before the high. Now we make a lower high, lower low, lower high, lower low, lower high, lower low. Again, two question marks, we'll cover them. And here we make a new higher high, higher low, higher high, higher low, higher high. So before I cover the question marks, I want you to think why I've written these question marks down. What do you think they mean and why do you think I have them here? If you remember last time, and I want to go back to this example, we know that every single expansion and retracement has a same market structure within each straight line. So one straight line on one time frame, if we drop 1 or 2 time frames and we then look at it, we will see the exact same market structure on the line that we just saw on the bigger picture. So looking at this then, what we see is that here is the high, low. So on the bigger picture, on the grand scheme of things, this is one straight line. It means that this high that's forming right here isn't higher than this high. And this cannot yet be a lower high because the lower high, if you remember what I said a minute ago, would be confirmed the moment we close below this low. So right here, this is nothing. But if we, let's say, zoom into this whole delivery from this high to this low, we can see tinier ups and downs. Low, high, low, high, low, high, low. Meaning that this only solely big green up close candle is our is our lower high before the lower low. So the moment we break this high, this wick right here, we can see that this is a smaller or lower time frame, higher high. And then this would then be our higher low, higher high. Now, if you keep this in mind, let's look at this example then. Here we have 2 question marks again. This is the lower high, the high to low on this one line. Now, if we zoom into this though, keep in mind, the markets are fractal. If we zoom in, we see low, we see a high, we see a low, we see a high with this wick, we see a low. So this wick is our most recent lower high. And what does this mean? The moment we close above it, we've made CST and changed structure to the upside. So this is a smaller time frame, a lower time frame, CST making a higher high, meaning that this would be a higher low, higher high, higher low, higher high, higher low, higher high. So I hope you now understand how the markets work. It either goes up or it goes down, and it can be defined with higher highs, higher lows, lower lows, and lower highs. This is the only thing the market can do. Even if it looks like it's going sideways, it's still making either ups or downs. So in the last slide, I was talking about higher time frame versus lower time frame, meaning that when we look at a bigger swing, this is usually on the higher time frame, but within it, on the lower time frame, we can find smaller market structure. So these are subjective, what you determine or decide being your higher time frame versus lower time frame. But the point is that you make your analysis, your direction, and your idea where we're going on the bigger picture on your higher time frame. And then you use the lower time frame to execute the trade. So this is your execution time frame. And some usual examples or some usual time frames that you use for the higher time frame and lower time frame is the 1 month time frame for the higher time frame, the daily for your lower and execution time frame, the daily and the hourly, where the daily is your higher time frame, the hourly is the lower time frame. And then we have the hourly and the 1 minute. And this is what I'm using, what I'm trading every single day. My hourly chart is my higher time frame where I make my analysis, where I make my direction, and the 1 minute is where I actually take the trades, which we'll cover later. And now we get to a very interesting topic, liquidity. First of all, we need to understand what even liquidity means. What is it, right? Liquidity is just resting orders in the market, and they get placed at highs and lows. There's liquidity all over the market, and it might be a bit confusing, but it will be a bit clearer on what this actually means and how it looks in the chart in a second. Because what I want you to understand is that retail traders see support and resistance. As you can see right here, this chart or this market has bounced off this low or these lows multiple times. And in the retail mind's eye, this is looked at as support, right? They look at this and say, oh, we have gotten support here. So what do? They place their stop orders below the support. And a stop order is the order that takes you out of the position you're in. Let's say you have been going long, you're saying that the market will go higher. If the market goes to a certain level below you, you will be taken out and take a loss. They place that level below this support. And the same goes for the opposite direction. Here we can see a market or a chart which has bounced off this specific level multiple times. And in the retail eye, this is looked at as resistance. The market is strongly rejecting that level and they say, oh, it's going lower. We can put our stops and protect ourselves above this level because they will not be reached. And now we need to go over the details of liquidity, get more in depth with what it actually is. Because what I've written here, the first thing I've written is liquidity is everything. You need to understand that smart money is always seeking liquidity. We are either drawing towards liquidity or away from liquidity. But this drawing away from liquidity is drawing towards something that is called internal liquidity. So the market is always seeking liquidity on the bigger or smaller time frame, on the bigger and smaller perspective and move. Every single thing is liquidity. And you will understand this very soon. So I've written here external liquidity, which is shortened ERL, to internal liquidity, which is shortened IRL. And this is exactly how the market moves. It moves from or it moves to external liquidity, and then it goes to internal liquidity. It goes to external liquidity, it goes to internal liquidity. And this pattern or this move keeps repeating every single time. And this is what will start to make a lot of sense. And I will not go back to the previous slide, but we will soon see something that I think you will start to be like, wow, now I start to see things. And the final word or the final terminology I want you to remember is buy side liquidity, BSL, and sell side liquidity, sell side liquidity. And the only thing you need to understand, might sound like a fancy word, buy side liquidity is always above us, sell side liquidity is always below us. So that is the most simple way to put it and the only thing you need to remember. Green, buy side liquidity always above us, red, sell side liquidity always below us. That's it. And this is just ways of determining the liquidity. If you want to understand why this is called what it's called, it's because above us we put the buy stop orders. That's what they're called. Below us we put the sell stop orders. That's what those orders are called in the actual marketplace. Because when you go short, let's say right here you go short, what you have actually done is you have pressed a market. What you have actually done here is you have pressed a market or you have made an order that's called sell. And in order to take out your position, if you're wrong, you have to buy it back. You buy your own thing, you're selling. And on the other end, let's say that you are long, you have taken a position somewhere here, you say that the market will go higher. What you have done is you have bought one contract, let's say. You have bought one. In order to sell that, in order to get equal or even on this position so you're no longer in it, you have to sell the equal amount you're in. And that's why this is a sell limit, the sell side liquidity. So let's look at this thing right here, the external to external liquidity. What does it actually look like? And what you can see right here is that this is a chart or a market which goes higher, lower, higher, lower, higher, lower, higher. And if we go back to this chart, it looks kind of the same, doesn't it? The market goes lower, higher, lower, higher, higher. And this is all liquidity. And I'll show you in a second. So this is how the market moves. We move to an external liquidity right here. We make a new high. We retrace back into an internal liquidity, internal compared to this leg on the left. We make a high, taking out external liquidity right here. We make a low, high, finding support in internal liquidity compared to the left, and so on. So the market is only rooting or hunting for liquidity. Let's look at it on a real chart, and I want you to now do the exercise that we did previously. What I want you to do is look at this chart. First of all, screenshot it as always. Mark out highs and lows that you can see. I want you to look at the levels and just mark out a straight line like this. If you see a high, if we go back right here, let's say you see this high, I want you to make a line right like that to the right. If you see a low, you make a line to the right, symbolizing sell side liquidity. So take a look at this one, mark out all the highs, all the lows that you can see, and also if you can spot some internal liquidity that we retrace into. So pause this now, I'll give you one more chance because now I'll switch to the next chart. And here we go. What we can see now is I've marked out internal liquidity, I've marked out buy side liquidity, I've marked out sell side liquidity in an easy manner. Now what do I mean? Well, we can make this more complicated, more advanced, but this is the main and most important part I need you to see first. Because first of all, I want you to compare it. How did you make it? How did you see liquidity? What liquidity did you spot? Because now what we can see is that here the market forms a high. And if you remember, what was this called? If we look at it from a market structure perspective, this is a higher high. Now we made a new low back into internal liquidity compared to the left. Now, what we see is that the market goes higher, goes lower into an internal liquidity right there. And now the market takes out all the buy side liquidity resting above this high and this high that formed right in advance of it. So here you can see an example of where buy side liquidity was resting above all of these highs. Retail traders view this, if you remember, they view it as as resistance right here, put their buy stop orders right above it, and this is our buy side liquidity, which we want to target. And then we see a new example. We make a new high, we retrace lower, forming new buy side liquidity right there, taking it out. And this is how the market moves. Now we make CST to the downside. And what I said before, what I want you to understand is that every single low here has sell side liquidity we can draw to the right as well. So when the market eventually turns, it gives us these sell side liquidity pools to the left that we can target right here. This has sell side right there. This as well. So let's say now we know that the market has changed structure, which it actually did right there. Liquidity areas are where we want to target our trades, where we want to take trades to, because we know that the market needs to reach a liquidity level before it can reverse. Again, starting to make sense? So if we continue to take a look, we make CST here. Here is the final high. We now make a lower low. Now we start to target all this liquidity that's resting below this low, and this low. And there is indeed hierarchy to liquidity. Equal lows, the more equal lows you can find, the stronger the magnet is. The more alone the liquidity is, the more alone the level is. What I mean by alone is, let's say this one, it's very far, very alone. Or now we have this high that's very alone. These are strong liquidity pools as well. And then we see that we eventually take this low out, making a new sell side liquidity right here. And now when we make this turn at this level, I haven't written it out, but all of these highs have buy side liquidity resting above them, which we want to target. So we always target buy side or sell side liquidity. Now, the final thing I want you to remember in regards to liquidity, envision it like a magnet. There's always a magnet at the liquidity. We will always need to reach it and go to it. So just remember that. That's what I want you to keep in mind. And now, now we'll go over a new topic or two new words that I want you to remember, only short, because we'll cover it way more in depth later. So now I just want you to remember the name. And it's POI and DOL. This stands for point of interest. It stands for draw on liquidity. And as I said, it will be covered way down the line. I just want you to remember this, because this is how we determine and how we look at ERL, IRL. If we go back here, ERL, IRL, ERL, IRL. External liquidity is always our drawn liquidity. The ERL is always our points of interest. So the point of interest basically, and the only thing I needed to understand for now is that that's where we want to take a trade from. The drawn liquidity is where we want to take the trade to. What liquidity are we targeting? So we can now start to see and understand how all the reversals occur at the point of interest, and all of them target a drawn liquidity. Now the next topic and the next subject we will cover is premium versus discount. Premium and discount are reference points in where a market is in a specific range. And we want to buy, meaning we want to go long in discount, which is this green area right here. And we want to sell / go short in premium, in the red shaded zone. Equilibrium is another word I'll need you to remember. EQ is the middle point, the 50% of the range of a low to high. EQ is always the 50% of it. Now you might wonder, like, okay, Daniel, like, I get it. I get premium and discount, we want to sell in premium, go long in discount, and so on. Where do we mark it from? Well, premium and discount is always marked from the most recent low to high. So a low to high is a range. A high to low is a range. So we can draw it from a swing high to a swing low, from a swing low to a swing high, and that will give us the range, which will give us the premium and discount within it. And what we'll see in the next image is that it's not always that a reversal occurs in premium and discount, but that's where the best ones occur. And that's something, by the way, I wanted to remember for the whole video. All of these concepts we talk about, of course, they're not working every single day, every single hour, every single minute. Then it will be super easy. We'd have 100% win rate and win every single trade. So that is just something for you to keep in mind, because you will also find that when starting to do the homework and actually looking at the charts yourself. Everything is not always there, but that tells us that we should not engage in the market. So the thing I want you to understand with premium and discount is it answers the question to where can we expect the market to retrace to before it expands again. If we go back to this image, it means that we can look at an expansion leg, let's say from this low to this high, and say where can we then see the retracement from when we, let's say, know that a high is in. How far can we retrace? What's the minimum we need to retrace before we eventually continue higher again? And the same goes here, low to high. So let's take a look at an example. Right here you can see there are marked out a chart. And this is, by the way, the exact same chart as this one. Now we are just looking at premium and discount. Here we can see a low to high. This gives us a range, our premium to discount range. What we see is that we go up to this high, and again, where can we reverse or retrace? How far is the minimum we need to retrace before we can see a reversal higher? And what do we see? We see price just tapping the equilibrium level, just tapping the discount before we continue higher. And then here's an example where it didn't really work. We low to high here, EQ is maybe somewhere here. But let's take a look at this, high to low. See that the market made a high, made a low, we retrace back into the midpoint before we continue expanding further to the downside. Another example here, high to low gives us the range, EQ is right there, and we see the retracement from this low up until this, making this lower high right here at EQ, just above it, in premium, and then we expand further. Now on the flip side, we make a low, we make a higher high compared to this one. Where can we retrace before we continue the expansion? At EQ. Do you see how the market is rejecting or respecting this level? That's what I need you to remember. Same goes here. So I hope now you start to understand, okay, what does this look like? What does it help us with? Because this is a way we can anticipate where the market will reverse from, when it's allowed to or when it's not allowed to reverse yet. So let's go over into the new word here, into a new word, order flow. And this is an important term that we'll use very often. I'll say it a lot of times, so I need you to follow along on what it is. Because basically it's very simple. It's basically market structure, right? Kind of. We either have bullish order flow or we either have bearish order flow. If we have bullish order flow, we see expansions higher, retracements lower. We see expansions higher and we see retracements lower. And the key is that we never take out the previous low. So this is basically bullish market structure. If we look at this example, we can see that we have higher highs, higher lows, higher highs, higher lows. This is bullish order flow. And if we have bearish order flow, it's the exact same, but turned around. We see expansions lower, retracements higher, expansions lower, retracements higher, expansions lower, and we never take out the previous high. Now, when we are in a bullish environment, when we have bullish order flow, longs thrive. we want to take longs because they will be the cleanest opportunities. And the same goes for a bearish environment. We want to take shorts. We want to go against the market. And the best trades that you will see and that you will find are always in line with order flow. If you trade against order flow, you take something that's called a retracement trade, which we'll cover later. And the reason order flow is very important, very interesting once you start to see it, is because this is how we start anticipating things, how we start to put pieces together. Okay, we have bullish order flows, which means we can anticipate certain things to happen and we can anticipate certain things to not happen. So that is what I want you to keep in mind and remember, which we'll talk about later. Just remember those words because it will make sense in a bit. Because now we'll cover something which is, honestly, this is almost everything. I know I've said it a few times, but you'll realize that this is the whole cake. This is everything, and everything we will talk about will all be added into this thing called market maker models. And the market maker models will cover in chapter 4. So now we'll just talk about the basics here, just go over it very, very briefly so you understand what it is and can keep it in your mind moving forward. Because every expansion, retracement, expansion on a higher time frame is a lower time frame market maker model. Just remember this for now, how it looks, as you can see on the schematics right here. This is a bullish market maker model, which is called a market maker buy model, hence the MMBM. This is a bearish example where we have a MMXM, market maker sell model, where we can see the market go lower from here. Now, if you remember POI, DOL, as I talked about just here, these come in handy when we start looking at these market maker models. So just remember this for now. And now we're starting to get to the close or towards the end of chapter 1. So here is the homework that I need you to do. Either you decide before getting on to chapter 2 or after this video. So the first example is the first exercise is make 20 examples on the 1 hour chart on NASDAQ where you mark out the market structure. And if you remember, that is what we did over here. We looked at a chart, we marked out the lows, the highs, the lows, the highs, like this. So I want you to do this, 20 examples. This would be one example. So go into the NASDAQ chart, the hourly chart, the 1 hour time frame, and then you look at a frame where you see whatever you see on the chart and you mark it out. The second exercise is make 20 examples where you drop into one hourly low to high or hourly high to low. I want you to drop into the 5-minute chart and make the same market structure. If you remember what I said, each line on a high time frame can be zoomed into and you will see the same thing. So I want you to look at a expansion or retracement on the hourly chart, mark it out, go into the 5-minute chart and mark out the exact same things you will see in it. The third exercise, make 20 examples of premium to discount where you see us expand, retrace back into 50% and then expand higher again. And to use this, I recommend either using the Fibonacci tool or the Gann box in TradingView. And the final exercise is to make 20 examples where we mark out the buy side liquidity and the sell side liquidity on an hourly chart. So this means that you would look at a chart just like this again, and then you mark out every single high and low you can see. This wouldn't be a valid example. I would like you to write out all the lows and highs. So this would be a sell side liquidity, this would be a sell side liquidity, even this low, and all of these highs, this tiny high, this high, this high, because what you'll start to see will be very interesting. So this is the end of chapter 1, and you should now understand the following: what the financial markets are, how bullish and bearish market structure works, and what actually objectively defines them. If I ask you what is bullish, you should be able to tell me. If I ask you what's bearish, you should be able to tell me. I want you to remember and understand what liquidity is and how the market utilizes it, what external range liquidity is, what internal range liquidity is, how premium and discount works and what it is, and just what the word's point of interest drawn liquidity is, and more importantly, how a candlestick works and what it represents. So if you don't yet understand all of this, go back to the part or parts you need to re-listen before you move on to chapter 2. So this is chapter 2, and chapter 2 will be about time and how we'll utilize and look at time in the market. Because first of all, like, what is time and why do we even care about it, you might say? Because not many people talk about time when it comes to trading. First of all, what we need to understand is that every single chart has two axes, right? We have the y-axis and we have the x-axis. Y stands for price and X is time. Price is printing all the time. I will need you to understand that. We always have price printing, right? Time is the filter to price, so we know when to trade. Because we don't want to look at the charts every single day, every single hour of the day. We need to filter out when we're actually looking at a chart. So what you need to remember is that time always comes before price. View time as the market schedule, because price is delivered by an algorithm that runs on both time and price. Because what you'll see is that at certain times, certain days, certain events, the market will inject volatility on specific times. So time is very important, and we will talk about it for this whole chapter. And the first thing we need to understand is, how do we measure time, right? Because yeah, time sounds cool and all, but why or how do we measure it? And it's measured by time cycles. And if you remember what we spoke about from the previous chapter, we said that time and price, or then we said that price is fractal. What we saw on one leg, if we zoomed into it, we can see the same things within it. The same goes for time. Time is also fractal. This means that every single cycle can be divided into smaller cycles within it. So let's go over the cycles we have. And as you can see here, we have this schematic right here, where we start off with the yearly cycle. And in a yearly cycle, which is obviously from the 1st of January to the 31st of December, within it we have 4 quarterly cycles. So we have Q1, we have Q2, Q3, and Q4. And within every quarter, we have 3 separate months. As you can see right here, this orange block turns into these 3 blocks, these 3 months. So for Q1, we have January, we have February, and we have March. And every month can then be separated and divided into 4 separate weeks. So we have week 1, week 2, week 3, and week 4. And every single week has what? It has 5 days. So we can divide these, or 1 week, into 5 separate days. So Monday, Tuesday, Wednesday, Monday, Tuesday, Wednesday, Thursday, and Friday. And now we start to get into the more narrow aspects of time, because every day has sessions. What are these sessions? We have Asia session, we have London session, we have New York morning/AM session, and we have New York afternoon/PM session. And we'll get more in depth with them in a second. And every session can then be divided into 3 90-minute cycles. What I want you to remember as well is that the way we trade, the way I trade, and how you will learn to trade, focus will not be on trading the Asia session actively. Just remember that it's a session, and I'll go over the times more in depth. And then if we look at the 90-minute cycles, every single 90-minute cycle can be divided into 3 separate 30-minute cycles. And if we want to go one step further, we can even take one 30-minute box and divide it into 3 10-minute cycles. So here is a more in-depth view of the sessions that we have. And before we even start talking about any times or so on, I want you to remember that every single time that I will talk about will be in New York time, in EST time zone. And this is in general how we speak about time in the markets. So every time I reference, let's say 10 a.m., it's 10 a.m. in New York time. So we have 4 sessions, right? And as I just said, we don't look at the Asia session unless we trade, let's say, Asian FX pairs. So let's say you trade JPY, you trade AUD and these kind of forex pairs, or you trade like gold or silver. They usually move more during Asia session. But the futures, which we will focus on, is not a session of interest that we want to look at. So as you can see on this schematic right here, we have the Asia session, the London, the New York AM and the New York PM. They range from these times. So from 6 p.m. to 2:30 a.m. the day after, we have Asia session. From 2:30 a.m. to 7 a.m. we have the London session. From 7 a.m. to 11:30 a.m. we have New York session. And from 11:30 to 4 p.m. we have the New York PM session. And as you can see, if you look closely here, from 4 p.m. to 6 p.m. there's nothing. And this is because the market closes at 4 and then it opens up again at 6. So we have a 2-hour gap that we're not trading, that we are not having any cycles or sessions active. And if we go back to the previous part here with the fractality of the time cycles, what we saw that was that one session like this could be divided into 3 90-minute cycles. Because if you look closely here, 2:30 to 7 a.m. is how many minutes? It's 270 minutes. And 270 can be divided by 3. Hence why we have 3 90-minute cycles right here. And here we have cycle 1, cycle 2, cycle 3. For London, this would be 2:30 to 4 a.m., 4 a.m. to 5:30, and 5:30 to 7 a.m. New York AM, just like you can see right here, 7 a.m. to 8:30, 8:30 to 10, and 10 to 11:30. The 90-minute cycles for PM would be just like 11:30 to 1, 1 to 2:30, and 2:30 to 4. Now for Asia, as you can see, it's a bit of a longer session, and that's why we don't pay attention to it in regards to these cycles. And then of course, every single 90-minute cycle, just like we talked about, could be divided into 3 separate 30-minute cycles within that 90-minute cycle. Now, each cycle, each 1, 2, or 3 has a function. And this comes down to a term that we'll go over soon. That's called AMD. Accumulation, manipulation, and distribution. Because as I told you in the beginning, time is the way the market moves. Price runs all the time, so time is the schedule. The algorithms are driving price, which means that certain cycles, certain sessions has a certain function and has a certain deliverable it will have to meet. So this means that we can start to pay attention to these cycles based on specific events we want to see happen, when it's happened, when it will happen. And this gives us certain kill zones, when usually the market is the best. And when it comes to the AM session, which is the main one we're focusing on, I would say that from 9:30 to 11:30 is where you want to look at the markets. When it comes to PM, you want to look at it from 1 p.m. to at least 3 p.m. And during London, you want to look and engage the most from 3:30 to 4 a.m. up until 6 a.m. These are the time zones, or these are the time periods where the market is usually moving the best. Now, if you pay attention to what I just said, what you notice is that most of these kill zones appear around the cycle 2, which we'll get to in a second, because this is the manipulation cycle. This is where things usually starts to take place. Because what we'll learn is that cycle 1 usually has one function: consolidate, accumulate, slow down, engineer liquidity on both sides of the market so that the next cycle can open up and do one job: manipulate the market and then go in the right direction. And we'll cover this very soon. And as I said, AM session is the best. Why? Because at 9:30 the US stock market opens up. This is when the most volatility comes into the market, and you will learn and we'll go over the importance of 9:30 and so on. And now we'll get to I would say the midpoint between time cycles and their functions. Because what I just told you here was that each specific cycle has its own function. It has something that it has to do, right? Deliverables. This means that we have to pay attention to how these markets open, because every single time cycle has an opening price. If you remember the first slide with the candlesticks, we have the open, low, high, close. We have the open, high, low, close. The price at that level at the time cycle start is the opening price, right? So let's say we open up right here at 10 a.m. This line will be the price opening of 10 a.m. Now, why is this important? Well, it comes down to two things, because this is first of all one way to look at premium and discount based on time. But it's also one way to learn and see how we manipulate and where we distribute. Because what we'll get to is that we always want to be in the market and position ourselves just after the manipulation is done. And the manipulation is where the market takes out people right before it starts to move. And we want to position ourselves once the manipulation is over. So what you can see right here is that ideally we want to buy below an open and we want to sell above an open. This means if we look at a schematic right here, we open price here, we drop lower, and this is called the manipulation leg. In some words, they call it the Judas swing, which you might have heard, but this is basically the manipulation. We manipulate price lower, tricking people into thinking lower prices is next. They position themselves short, or we take out a lot of liquidity that's resting to the left. Once the manipulation is over, we will distribute higher, and we want to position ourselves as soon as we can in this area below the open, because we know that we are part of the manipulation phase, so we can continue with the distribution. Same goes for lower prices. We open up here, we go higher, and this is the manipulation. We manipulate people to think higher prices is next, and then we see price going lower. So one thing I want you to remember here is that when you start looking at the charts, you always, let's say you have a bullish bias, you always want to see the market in key openings. So let's say a weekly open, a daily open, a session or 90-minute cycle open. You want to see them open up heavily and sharp against you, because what you need to understand is that this is tricking the average trader into thinking, oh, we are strong, we are going lower, markets are strong to the downside, we are bearish. And that's exactly what you want to see if you are bullish. You will see this time and time and time again, and you will start to be like, wow, this is crazy. Because you can start to predict if we open high aggressively, and aggressively is the key word. You want to see sharp candles against you. You can almost start to be confident in your idea being right. Because if you were to open low and you were bearish, then most likely that might manipulate you and then go higher. Unless we know that the manipulation has already been in place. And this is something for the future, which we can cover later on. What we'll start to see is that the biggest swings for any specific cycle, obviously for bigger swings, we see bigger cycles. For smaller swings, we see smaller cycles. You will see that they all form, so every high forms above those key openings and the lows form below the key openings. So for example, if you're looking at swing/position trades, you want to monitor the yearly, the quarterly, and the monthly opening prices. For day trading, you want to monitor the weekly, the midnight open, which is 0000 in EST, and the 9:30 open. These are your key openings for day trading. And the final thing is, I want you to understand that the opening prices are key reference points in the markets. They are algorithmic reference points, and the reaction to these levels should always be monitored. How we react to these levels is crucial to pay attention to, because what you'll start to see when looking at this even more is that if we reject these levels, we can anticipate reversals from them, or if we displace through them, we can anticipate strength and continuation. So this is something for your own studies, for your own homework to do. Let's jump into an example and see how this actually looks in a real chart. So right here we can see that we have a hourly chart and we have a week of price delivery. You can see Monday here from this dotted line all the way to Friday where price ends. Now what we see is that the market opens up here at Sunday 6 p.m. Sunday 6 p.m. is the opening. We open initially lower, right? Market goes lower, lower slowly, right? And then we see the market shoot up higher from end of Monday and all of Tuesday goes higher. What we see taking place is the high of the week is forming right here on Wednesday, where above the weekly open. I hope that you can see it on this screen recording, but there's a orange line right here from the opening of this candle, which is the Sunday open, the weekly open. So right here you can see that the market has made a high of the week called HOTW, that's just a shortening for it, above the weekly open, the WO. And then the market just goes lower from here. Do you see how we originally open lows and then we make the real manipulation leg here to then make the distribution for the final days of the week? So if you remember what I said, each day, each cycle, each session has a function. Monday opens up rather slow, I'd say, and then Tuesday immediately just goes higher. It never goes lower. You can see here is the opening of Tuesday. So you can extend that to the right. And what you see is that market just goes higher, makes this manipulation leg. If we go back here, we see opening, high, low, close. Just like here. Let's go and take a look at another example. And now we have a daily price delivery instead, where we can see a 15-minute time frame. Each candle represents 15 minutes in time. So what we see is that the market opens up right here. I hope you can see it. There's a tiny line right here, which is the midnight open. We see that the market does one thing only when it opens up. It just goes lower. Here's the opening and we just go lower. Right there, we make one retracement, and then this is what I talked about of aggressive manipulation. We want to see these big candles against our idea because we know that that's how smart money tricks people into thinking we are going lower, because in the normal trader or retail trader's eye, this is strong distribution. This is strong market conditions saying we are going lower. That is not how the markets work. This is how we trick people into believing shorts. They fill up short orders, put their stops above each of these highs. If you remember liquidity, we put buy side liquidity all over these highs and then we target them later. So we see the market immediately open low. And right here we form a swing low to then continue higher for the rest of the day. And we eventually close above this open. So right here, the key I want you to see and what I want you to remember looking at opening prices, opening off cycles, is if it only goes higher or lower, you can almost guarantee that it will be manipulation, unless you know that the manipulation is done and the function of the new cycle is only to distribute and continue higher. And this will cover soon. So before we go into the next part, I want you to just understand that opening prices is a way that we reference and look at what price has done in relation to manipulation, distribution, but also in premium and discount. So let's go over the next thing when it comes to time, because as I said, time is how the market is delivered based on a schedule. We'll see certain times of the day that will inject major volatility. They will just shoot price higher or lower in a matter of milliseconds. And first of all, these are the main times that we have in the market that usually drives price. Remember, it's always EST. We have the 9:30 open, which is when the US stock market officially opens up every day. We have the 8:30 a.m., which is a typical news time. And two of the news that is very heavy is NFP, non-farm payroll, and we have the CPI, consumer price index. These are releases that come every 4 to 6 weeks, okay? And they are huge volatility injections and huge manipulation times. What I want you to understand is that news and news drivers is the way that smart money is manipulating the market. These are their smoke screens. These are times when they just inject volatility to go to where they want to go. They know that price has to go from here to here. So when they have a news driver, they utilize it to go a specific direction. Because remember, supply and demand, buying and selling pressure is not how the market is driven. And you might say, yeah, Daniel, but doesn't make sense. If we have good news, we'll go higher, right? Well, I want to pause you there because think about it like this. If we have a news event at 8:30, okay? How come literally the closest to millisecond after we can have, the market shoots 1, 2, 3% up or down? How is that possible with buying and selling pressure? I would say it's impossible. And more importantly, how come sometimes we have bullish news? So let's say we have a bullish news or a news event that releases something good that should drive price higher, right? But we see markets just tanking. How? It's because what I need you to remember is every single news is driven to be as or to act as smoke screens. They are not there to tell you what a news or what happened in the world, in the market, in the economy. They are purely there to trick and utilize the smoke screens of the media. So the media is the biggest smoke screen you'll ever see. During wars, they can change how they want to use the war framing, how they want to use what they are saying to go higher or lower. The same news, the same event, they will trick sometimes to go higher or sometimes to go lower, depending on what needs to happen in the market. So if we go back here, what we can see is we have FOMC, which is a two-stage event. We have FOMC at 2 p.m. and then we have a small pause to 2:30. What I will need you to remember is during this 2 to 2:30, we don't want to trade. And another general rule for these three rules or for these three events, FOMC, NFP, and CPI, we don't want to trade before it. The session before, the day up until that point, we don't want to trade. Because what you'll see is that the market will very often consolidate, slow down, be very choppy until this news driver. So the final important time I need you to pay attention to is 10 a.m. We usually have red folder news. And I'll now take you to a site that's called Forex Factory, where you can see these events occurring, where you can look at the calendar, because the calendar is crucial. That's how we can look and anticipate when things will happen. So the first thing I need you to remember is Forex Factory. This is Forex Factory. You just search Forex Factory, choose the calendar, and you'll see this occur, or this appear, I should say. To the left, you have the actual calendar, and right here, you can go from week to week and day. Even if you want to check one day, you just press one of these. Now, this looks like a mess, which it is, because the way we trade, the only things you need to pay attention to is the US market and red and orange folder news. So I'll show you now how to filter this out. So you press on the top right here, filter, and this will appear. I want you to detoggle every single one that isn't USD. So this will only leave you with this one. And right here, you can choose the impact of the news or impact of the event. We want to detoggle the yellow one. So we only have this one, which is bank holiday. We have the orange one and we have the red one. And this will immediately make the whole calendar look better. Now, what we see here is what happens or what will happen in the week or weeks ahead. For example, today it's Wednesday, the 29th of July. We can see that Monday we had President Trump speaking. And then one final thing I saw that I just missed that. I need you to make sure that you have the New York time right here. So press this clock on the top. Make sure you have New York time. Just save. So on Monday we had President Trump speaking. On Tuesday we had CB Consumer Confidence, which is one of those I spoke about, 10 a.m. And today we have FOMC. And as you can see, as I mentioned, it's a two-stage event. We have the FOMC statement, we have the FOMC press conference. Tomorrow we have 8:30 news, as you can see right here. And on Friday we have 8:30 and 10 a.m. Now, as you can see, some of these are folded or have the orange folders, some have the red folders. This just shows the volume or the strength of the news impact, the news event. How strong can you anticipate the markets? The orange ones you barely don't need to think about. The red ones are the ones I need to monitor and see what happens at those prices, at those times. So let's take a look at next week, just so we can get a feel for what it can look like. And right here we have an example of NFP. So Monday we have 10 a.m. red folder news. So this means on Monday we have to pay extra attention to 10 a.m. And what we can see is that up until this point, the market might be messy. It might be held tighter in a consolidation so that 10 a.m. can just boom, inject a lot of volatility. Same goes for Tuesday. JOLTS job openings. What's interesting here is that this shows a orange folder, but what you'll notice that this JOLTS can be very aggressive, very sharp with volatility. So this one should be treated as a red folder news. And then on Wednesday we have 2 orange folder news. Thursday we have 8:30 orange folder, and on Friday we have NFP. So as I said, non-farm payroll, which on Forex calendar always is called non-farm employment change. When this is, you have to pay crucial attention, because what you will see is that these weeks, especially the 1-2 days in advance, can be very, very slow. The markets can overall be in a very messy state on the hourly or daily time frame, because what you'll see is that they wait for this news. Just like I told you, the news isn't there to just tell you what happened. This is the smoke screen to run price wherever they need and want to take it. So what you'll see is that the NFP can be super huge. It can cause crazy volatility and you need to pay attention to. And the NFP is the first Friday of every new month. So before we leave this is something that I need you to look into at your own charts. Look at Forex calendar, look at these news events that I mentioned to you, and look at on the 1 minute time frame, but also sometimes on the hourly time frame, what happens and what these news looks like. NFP, CPI, FOMC are the main ones you will see things happening at. But then on the 1 minute time frame, the 9:30 open is always crucial and is a key reference point. Because what you'll most often see is that 9:30 is usually a manipulation leg. We see 9:30 open high aggressively. And what do we remember from this section? Well, if we open high aggressively, we know what? We know that that's usually manipulation to continue lower. So let's say you head into a day, you're bullish, you want to see higher prices. 9:30 comes along, it opens low aggressively. That's great news, because we know that eventually we will form a low and then we can go higher and take a trade to the upside. And the final thing I need to understand is why 9:30 is open, because remember, it's not a specific opening, it's not a specific time, like it doesn't open a new cycle. In the markets, we have electronic trading hours, which is 24/5, and we have regular trading hours, which is from 9:30 to 4 p.m. This is when the US stock markets opens and closes. So we have these 2 different reference points in how we are trading. We are always looking at the electronic trading hours, but the regular trading hours is also crucial to remember, because that's what the typical market will see. That's what it will see when it opens up. So this just opens up a new day. And now we start to get into the more detailed topic of time cycles, because as I mentioned, every single time cycle has a function. And the utilization of time cycles is called PXH, PXL. So previous something high, previous something low. Basically, we define the ranges, the lows to highs of any time period, any time cycle. So the key here is that each time cycle affects the next one, and the current time cycle refer to the previous one. This is how we get, for example, something new that will be introduced here. Time-based liquidity, which is key time-based liquidity areas. So rather than just marking out any random high and low, we can start looking at time-based highs and lows. And this is how we can anticipate what a time cycle will do based on what the previous one did. And this is, again, it comes down to AMD: accumulation, manipulation, distribution. And we'll go over this very soon. And here's a visual representation of what I just outlined. We have the orange box here, which is where we're standing right now, the current time cycle. To the left, we have the previous time cycle. And remember, the X can be shifted into anything. If you remember this one, we can change it into Y, so a yearly cycle. We can change it into a Q. We can change it into an M. W, D, S, 90, we put a C, and 30, we put a 30. So we can change the X into anything, which is very interesting because now we can start to see how these affect each other, how this previous cycle will affect the current cycle, and the current cycle will refer back to the previous cycle. And the current cycle eventually will affect how the next one opens up and what it does, which in turn refer back to the current, which will become the previous cycle. So this is how the market is always constantly moving from cycle low to cycle high, from cycle high to cycle low. Sometimes it will reject it, or it will continue and displace through it. Because what you'll start to see is that the market can only do two things once it approaches a PXH or PXL. It can either reject it and reverse, or it can continue. That's the only thing it can do. It either rejects and reverses, or it continues and displaces through them. So let's take a look at a chart. How does this actually look? So let's take a look at this example. Here we have 90-minute cycles. We have 7 a.m. to 8:30 right here, and this red pink dotted box is 8:30 to 10 a.m. What we see is that 7 to 8:30 is rather slow. It's moving in a downwards direction, but it's rather slow. We see 8:30 come along, slow open right here, and then boom, aggressive open low. Do you remember when we talked about opening prices? We slowly open, boom, aggressively goes lower with this big candle. What happens right here? We reject this previous cycle low, previous 90-minute cycle low, and then we reverse to the upside. So this is a case where we reject a previous time cycle. So if you go back to this schematic, previous cycle has its highs, its lows. Highs is right here, which you can draw a line to. We have the lows right here, which you can draw a line to. So now I've written out, or I've drawn out the highs and the lows of this 7 to 7:30, from 7 to 8:30 90-minute cycle. So what we see is that we open up right here, we open this current cycle, we go lower, we start to refer to the previous X low, previous 90-minute low right here. We tap it right here. Now the key here is, how do we react of it? Do we continue or do we reject it? And what we see taking place is that we reject this cycle, so we reject previous cycle, which then impacts how this current cycle will continue to move, because we can either reject it and reverse, or we can either continue by utilizing it as support or resistance. And in this case, we see both. We see first rejecting it, and then we get to the other end. Now remember, we can either reject this high and reverse, or we can displace through it and utilize this high as support on price, which is exactly what we see. Boom. And this is called purge and revert. We purge one cycle's high or low and revert to the opposite end of that cycle. We purge a previous cycle high, revert to the previous cycle low. We purge a previous cycle low, revert to previous cycle high. This is the way that the markets move. So this is what I need you to remember, and what you'll start to notice very quickly. And this again is accumulation, manipulation, and distribution. This is what you'll start to see. So let's look at another example. And this is with 30-minute cycles. This was 90-minute cycles. Now we're looking at 30-minute cycles. We see 7 to 7:30, 7:30 to 8, 8 to 8:30. Now, if you remember what I said, we can either reject or utilize it as support/resistance when we approach a high or low. And what do we see? We see this cycle slowly consolidating, making like a box. We see the next one go slightly open low, slightly. We displace through previous 30-minute high, retrace back into it, utilize it as support on price to continue up, to continue our bullish trend. Let's take a look at the next one. We open this up, immediately shoots higher, showing strength in the market, utilize it as support on price. Doesn't look super clear to the eye, but we are utilizing it as support to continue higher. The key is that we are not rejecting it and continuing lower. Now, if we start to add things together now, do you remember when I said opening prices is usually the manipulation, right? We usually want to see an opening against our direction to then go in our favor. Two things here. And this might be a bit too advanced for you right now, but I'm sure when you re-listen to this and when you look at your notes, you will soon understand what I mean. First of all, if a lower high is already in, meaning that the manipulation has already taken place, we can then anticipate opening prices to not manipulate but to distribute in our favor. So let's paint this up. How could this actually look? And I want you to monitor these boxes, right? So just like this and right here. So this can represent any cycle we want. Let's put it at 90-minute cycles. 90, 90, 90. Okay, we start with this cycle. Cycle A does this. And now cycle B. So this one goes lower. This means that right here at this circle, we open up this current cycle. Now, what did I just say? If the lower high is already in, we can anticipate the new opening to not manipulate, but to distribute in our favor. So let's assume we are bullish, we are going higher, markets are going higher for today, and we see this new opening. We have identified that this is already the low of this current move. So what do we anticipate? This market to only distribute higher. Does that make sense? Because this is what you will note, because this is a common confusion that you will otherwise get. You will anticipate every open to go lower, when in reality, there's no reason for it in this case to go lower. But what do we see? Well, we see that this cycle opens low. Why? Because the low isn't in here. The low hasn't occurred somewhere here. So we need to open low, manipulate to then go higher. Does that make sense? So this could be an example of why this takes place. We continuously see a displacement above a cycle, utilizing as support, continuing higher. Real resistance turned into support, and we continue higher. So that is what I needed to remember. And with more time, with more eyes on the chart, you will start to see this. Because before we get onto it, it just crossed my mind. The most important thing as a developing trader for you is to spend as much time in front of the charts as possible. Now, everyone who's already skipped this video, who's already closed it off because it's too long, whatever, they don't need to hear this, and they shouldn't hear this. This is for you who's still here. Because the most important thing you can do now in your upcoming journey as a trader is to spend so much time behind the charts. What you're doing is less important, just looking at the charts, because you will be amazed by how much patterns you can see, by how much things you see in the markets occurring every single day. The same things are repeating over and over and over again. So you just need to spend time on it, and eventually this will become like your first language. When you speak your first language, you are not thinking on what you're saying. You are not even thinking about what you will say in a few minutes. You don't care because it's so natural, it's so ingrained in your mind. The same goes for trading. The same goes for reading a chart. You'll get so good at understanding what has happened and what will happen and what is happening that you can look at literally a chart for, not even joking, 10 seconds and understand what will happen. Because it's so natural for you. You have looked at it so many times for so many hours. So I need you to remember this. Keep this in mind. Just look at the charts. Now you have the theory. Now you have the words and terminology and kind of meanings of what things is, what it works, how it works. So with more time, with just looking at these things, example over example over example, it will be so natural, so obvious to you when this is happening live. So that is something to remember for the rest of your trading career. That will help you. That is the difference between the traders who are confused by the traders who are not. It's about spending as much time on the chart as you possibly can. Now let us take a look at another example. Right here we can see an hourly chart with the days. So here we have a delivery of Tuesday, delivery of Wednesday, delivery of Thursday. What we see is that Tuesday goes lower. We see Wednesday slowly opening up here, and then right here aggressive open low. We see that we we take out the previous day's low, PDL, and then we form a low right here and then reverse higher. Now here's an example of Wednesday not reaching the high of Tuesday, where we see Thursday continuing in that direction. And here's a perfect example. The low is already in from Wednesday, meaning that Thursday doesn't need to open low. It can just distribute and continue in the same direction. And now you might think, okay, yeah, Daniel, but we never reached the Tuesday high. We will not always reach the first cycle's high or low. That doesn't always happen. And we don't need it to happen in order for us to take our profits, in order to take a trade and be done with the move. Because you could already target, let's say, this high, which is being reached here. You could target any high right here, which we'll get to later. But I just need you to understand that because I'm sure those questions can appear. And that is, again, as I told you in chapter 1, every example we show, every schematic we show doesn't always happen. Of course not. Every single human being on this world will be a trader if all the things we're showing happens every time. And this comes back to what I just told you. With more chart time, with more screen time, with more eyes trained, with more hours on your eyes, you will start to see and recognize when it's not happening, when it's happening. Intuition will start to come into play, which has its pros, it has its cons. But with more time, the intuition will be super crucial. So now we come to this famous topic that I've been speaking about for a few times now. AMD, accumulation, manipulation, and distribution. What we need to understand, first of all, if we go back right here, we can just change this to AMD. This is the ideal function of cycles. This is our ideal world of how a market will move. Because we will always see, before a market reaches, let's say, this high, we will see that we will slow down in advance of it, we'll go lower, and we'll eventually go higher. And this can now be done using this concept. Because what we'll see is if one time cycle is accumulating, we then want to see the next one manipulated with a few set of signatures at the low or high, depending on what direction. And then we can anticipate that it will distribute to the other side of cycle A. Do you remember what I said here? We didn't reach Tuesday high. In this case, we didn't, but this is the ideal AMD. We accumulate here, and keep in mind, accumulation in an ideal world is super slow. It's like a small box, but accumulation can also be lower in this case. So the key is to understand that we use time-based functions, not how it looks for the eye. Because again, only two things can ever happen when we reach a PXH or PXL. We either purge it and revert to the other side, or we displace through it, utilize it as support, slash resistance on price and continue. So as the trader, we want to wait for the confirmation of the manipulation leg being done to position ourselves in the anticipated distribution. So let's say that we are looking for higher prices right here. Right here, this is a cycle. We accumulate. The next cycle opens up, opens low. And what we then see is that the market continues to distribute in our favor, targeting first of all this high. So let's take a look at this even deeper, because what we can see is that this can be applied on any single time cycle. Do you remember that we always had 3 cycles? We had 3 90-minute cycles, we had 3 30-minute cycles. The reason for 3 is that we can make these AMD. AMD are 3 letters: accumulation, manipulation, distribution. So in an ideal world, we want to see cycle 1, cycle 2 and cycle 3 play together. This doesn't always happen, but this is what we want to see. We see cycle 1 accumulate, consolidate, be slow. We see cycle 2 open low right here. So this can be shortened as London 1, AM1, PM1. Stands for London 1 is of course 2:30 to 4. AM1 is of course 7 to 8:30. PM1 is 11:30 to 1. The next cycle, London 2 opens low, takes out London 1's low, and London 3 eventually continues in the direction. In general, as I said, in the ideal world, in the perfect example, we see AM2, London 2, PM2 always manipulate the first cycle. This is what we see most of the times. These are where the best trades always occur, where the cleanest price action is, and where we want to be as sharp as possible to actually take place or to engage with these moves. So if you go into your own charts, you'll see that most SMRs will form during a manipulation cycle. Now this doesn't always mean that we form it in a 90-minute manipulation cycle. This could be a 30-minute manipulation cycle, because if you remember, every single cycle has its own AMD if we fractalize it. If we look at, I want to go back to this image. If we look at cycle 1, now you know and understand that this is AMD. This is not cycle 1, cycle 2, cycle 3. This is AMD. If we look at the A cycle, we can then drop into the 30-minute cycles, and we now have AMD within a cycle. The same would go for a D cycle. We have 10 to 11:30, but then we have 10 to 10:30, 10:30 to 11, and 11 to 11:30, where 10:30 to 11 would be what? Would be the 30-minute manipulation cycle. So what you'll see is most of the time a lower high is formed in some manipulation cycle. And if we mark out a dream AMD example, what you want to see is that the first cycle almost doesn't move. It's super slow. It engineers liquidity right in advance of the higher time frame target we have, so we can then take it out first and then go to the target. And here again we have the exact same chart that I just showed you, the same schematic. So all of these 2 cycles is the manipulation cycle. For sessions, we don't really look at it from London should always accumulate, New York manipulate, and PM distribute, because it's such a big time gap. It's such a big time window. So here we have to be more adaptive. We have to pay attention to what cycle did in advance, so the previous cycle, session, to anticipate based on reactions on the current session. So this is something that you will start to see as well. Most of the times, if Asia is slow, we can anticipate London to take it out and then reverse. If both Asia and London is slow, they both are accumulating. We can anticipate the AM session to come in, take out the lower high and reverse to the opposite end. So let's look at how this actually looks on a real chart. So what we can see is a 90-minute AMD in play. We see the 90-minute cycles of New York AM right here. Cycle 1, cycle 2, cycle 3. The blue box right here is 7 AM to 8:30 AM right here. This is on the 1 minute chart, and you can see that if you count, there are 91 minute candles. The pink or red box is the 8:30 a.m. to 10 a.m. right here. And 10 a.m. continues to 11:30 with the green box. What do we see? Well, first of all, I want you to just pause this before I start to say something. What do you see in regards to AMD? So take a look at this, take your time, and I want you to pause it now. If you didn't pause, this is your last chance. What we can see right here, and I hope that you paused, if you didn't do so now, what we see is that accumulation phase or cycle 1 is right here. We see that 7 to 8:30 is rather slow. We see 8:30 come along, immediately open high, taking out the AM1 high, taking out the previous cycle high, forming a swing high right here, continuing lower. Eventually we see one more push higher, not taking out this high. And then what does 10 a.m. do? It it's very narrowly opens high, as you can see right here, 2 up close candles, and then distributing lower. Accumulation, manipulation, distribution, targeting this low. Do you remember we always target the cycle 1 low or high in a AMD. Let's take a look at another example. And now we're looking at sessions instead. So right here we see an AMD not with 90 or 30 minute cycles, but with sessions. Okay. And this is on the 5 minute time frame on the 20th of July 2026, if you want to look at it on your own chart. Right here I've marked out with the blue shaded box London, pink is AM, green is PM. So we have AMD right here. Now this is a very good example of how AMD can look, because in an ideal world we just purge it and then reverse. But what do we see here? We see London go higher slowly. We see AM open high twice. So here we makes a high, here we makes another high. This is eventually the real high. We go lower, PM open high, low, taking out the London low. So this is another example of how AMD can look. And this is also a good example of how it's not always perfect. What you see right here is a real example. And this is where adding every piece and puzzle together is where you start to note when it's in, when it's not in. Because you might say, yeah, but why isn't this the high? A few things, but we have to confirm it, comparing it with a few more things, which we'll get to later on. It's too advanced for you still. I hope that by now you start to see how this looks, how the impact of time cycles actually work, how the impact of specific levels work, and how they function, and how we can anticipate what a next time cycle will do. So let's take a look at a third example. And right here, you can see a 30-minute cycle. Within, do you remember what I said? Every cycle has a smaller AMD within it. This is the accumulation cycle of PM1, 11:30 to 1 PM. That's a accumulation 90-minute cycle. Now, within it, we have an AMD as well. We have the accumulation of the accumulation, 11:30 to 12. We have the 12 to 12:30, which is the 30-minute manipulation. And then we have the 12:30 to 1 PM. So within a bigger cycle, we can find a smaller cycle AMD, because the markets are fractal. And you will start to see this time and time again. What do we see on the chart? We see 11:30 to 12 open, and here from, let's say this would be like 11:50, we start to go higher. 12 to 12:30 does one thing, it opens high aggressively. Do you note the big candles to the upside? This is typical manipulation. We then see price slowing down, and 12:30 comes along, and 12:30 only does one thing, it just shoots lower, it just shoots price lower, it distributes lower. Why doesn't 1230 needs to open high and take out this high if we are bearish? I hope you paused the video, because the answer is that the high was already confirmed right here for us to continue lower. So 1230 didn't need to make a final manipulation higher. The manipulation had already taken place and we could now just go lower. So now let's move on from AMD, and AMD is something that we'll talk about every single time. We'll talk about it way more advanced the further we go down the line. But what I want you to remember and keep in mind is that AMD is how we utilize PXH, PXL, how we look at delivery cycles, delivery profiles, which is another term, just saying that we can start to anticipate when and where things will form, when and where things will move, and what certain cycles will do. So let's now go into a new topic, which is called SMT. Because I hope that one question appeared for you a few times. How do we know when the high or low is in? Okay? And the thing is that we can know, because if time is so important, shouldn't we be able to know when things will start to move? And the truth is that we can do. And this is with SMT, which stands for Smart Money Time. When is the time right for smart money to make its final move? So SMT is basically intermarket relationship, which stands for the relationship between two correlated markets, and we'll cover this later as well. So what we will see is that intermarket relationship, when two correlated markets are cracking a correlation, meaning when one market that should, or when two markets that should move in tandem, making the same highs, the same lows, when one of them is off, when it doesn't, that creates the SMT. What if you want to understand the why and the underlying factor to why this happens when big institutions are buying or selling one asset heavily, which creates this cracking correlation, because you'll see that it makes a slight lower low compared to the other market that makes a lower high. This creates the SMT. We'll show you in a schematic in a second, and then the market is allowed to run. Because what we'll soon start to talk about is that how every high and low, I like to call it like a cake. It all requires a set of ingredients that needs to be there every single time. If you're baking a cake, you always need to have a few set of ingredients. Otherwise, you'll end up baking a bread, let's say, rather than the cake. So the same goes for every high and low. They all have a specific set of things that needs to be there. And one of them is the SMT. Without an SMT, you cannot say that a high or low is in. So we'll get to this later on. Every single market reversal, every single big or small swing has SMT. I need you to note that down, because you will be amazed on what you will eventually start to find out when you look at the charts. And we can measure SMT based on time. We have time-based SMT. That's where the real magic happens, where we see SMT cracking correlation between time cycles, okay? And then we have a word that's called double SMT. This is when we have two SMT, two different types of cracks at one specific high or low, which gives you an extra strength and signal and confidence on that low and high being in. And we'll get to this more as we go. Here's a visual representation when we look at SMT. We have market A, market B. They are always intact. They are correlated market. They are moving in sync with each other. What we see is that market A takes out the prior low, this orange low. Both made this orange low, as you can see. But market A takes this low out. You can see this dotted line. It goes below it, whilst market B never does. This creates the crack in correlation in relationship to this previous low. Market A makes a lower low, market B makes a higher low, which allows the market to continue higher. Now what can we see here? Well, we see if we fractalize this, and this is a bit more advanced, but for those of you who are following along, I think you'll smile. Here you can see a smaller AMD in play. Accumulation, manipulation below this point of interest, or this liquidity pool, make the low, form it, and then we distribute higher. Now, before we continue, I want you to just understand correlated markets. I'll give you a few examples. For us, we look at NASDAQ, NQ, we look at Dow Jones, YM, we look at ES, the S&P 500. Out of these three, I want you to start looking at ES and NQ. These are the most correlated, but I also want you eventually, with more time, with more experience, to start paying attention to YM, the Dow Jones. Because you will see that when these markets make cracking correlations, that's when the magic happens. If we look at the Forex pairs, you have Euro USD, JBP USD, so the pound versus the dollar, and the euro versus the dollar. Those are the most correlated pairs. We also can start to look at Euro USD versus purely the dollar. But that is more advanced because it's inversely correlated. That is it's mirrored, right? So these are examples. If we look at the crypto market, we have Bitcoin and Ethereum. That's an example of a correlated market. If you look at, let's say, metals, we have gold and silver. They're correlated markets. So these are markets that you can look at to find the SMTs. So let's now look at an example, right? Let's take a look at this. And now you need to be sharp. You need to pay attention. And I first of all need you to just remember what this looks like. One market makes a lower low whilst the other makes a higher low. Or on the opposite end, one market makes a higher high whilst the other one makes a lower high. Now we have NASDAQ on the left, NQ. We have ES on the right, ES. I want you to pay attention now. This is the hourly chart. We can see the days. See Monday, Tuesday, Wednesday, Thursday. Same here, Monday, Tuesday, Wednesday, Thursday. This is the hourly chart. And I want you to find where you can spot the difference in these markets. Can you spot a cracking correlation between these markets? So pause this video, look at it for as long as you need, and then mark it out or pinpoint where you see it before we go into it. So I will now switch slides. So if you haven't paused it, do so now. And right there, we can see a cracking correlation between NASDAQ and ES. What type of cracking correlation? Well, this is a daily SMT. We see previous day high SMT between NQ and ES. We have the Tuesday high right here, Tuesday high right there. ES takes out and makes a new daily high, whilst we see NQ never make it. It doesn't get to this high, forming a swing high on both markets, and we see what happened afterward, a deep and heavy drop to the downside. Let's take a look at another example. Now we are looking at the 90-minute cycles, okay? See a 1-minute chart. Here we have NASDAQ, here we have ES, okay? Pause this video, find a crack in correlation between these time cycles. See what you can find. So I want you to pause the video now, mark out where you see a crack in correlation, and then let's take a look together. So I hope you paused it because now I'll show the answer. Right there, we can see that we have the AMD, where we have the manipulation cycle, the AM2 cycle on NQ right here being taken out by AM3. You can see that it takes out the previous cycle low. What happens on ES at the same time? We have the we have the AM2 cycle right here, AM3 right here, which never takes out the low that was formed in the previous cycle, creating a previous cycle low SMT, a 90-minute cycle SMT, because NQ makes the low while ES doesn't, exactly like we see right here. AM2 stopped right here, AM3 opens low, boom. AM3 opens up here on ES, never takes out this low, creating the SMT, cracking correlation, and we can now continue the market. So now we are approaching the end of chapter 2 of time. And now it comes down to the homework. What do you need to do in order to actually understand this? Because hearing and listening and noting down is one thing, but what I just told you before was you need to spend as much time as you can studying and looking at these things. So what I want you to do, either based on how you prefer it, either you pause the video after this, do the homework, come back for the next chapter, or you watch the whole video and do each specific homework after. First of all, you need to collect 20 examples on the 1 minute chart of a purge and revert from PX low to PXH or from PXH to PXL. And you can look at the 30-minute cycles, the 90-minute cycles, you can look at the sessions or even days. But for the 1 minute chart, I want to focus on the 30, 90 and sessions, okay? I want you to collect 10 examples where you see 90-minute cycle AMDs. Again, if we go back right here, this is a 90-minute AMD where we utilized 90-minute cycles, okay? I want you to do the exact same for 30-minute cycles. So this would be an example of that, AMD on 30-minute cycles. And then I want you to collect 10 examples of time-based SMT with ES and NQ on every cycle, okay? So this is from the 30-minute to the weekly. This will mean that you have 50 examples in total that you need to collect, the weekly, the daily, sessions, 90 and 30. Now just to be clear, and we'll go over into TradingView just so I can show you proper examples of this, you need to look at weekly SMTs. This means a cracking correlation in reference to a weekly high or low, not a weekly, the previous week's high or low. Same goes for daily, session, 90 and 30. So let's jump into how I want you to do it right now. So right here, we can see that we have TradingView open, right? We have NASDAQ on the left. This is the quarterly contract, the current contract for NASDAQ NQU 2026. We have ESU 2026 on the right. Now, what do I need you to pay attention to? Well, what did I tell you? We look at the previous week's delivery. Right here, you will mark out the highs and lows of previous week to find and spot the SMTs. So we have Monday to Friday. Today it's Wednesday right here. We look at previous week. So the high of previous week we can spot on Tuesday right there. I want you to make use of this horizontal ray that you can find right here. This one, the horizontal ray, star it so it will be saved. Make sure you have this star on so this will always be handy and close to you. And then you can type on it. I have saved this template as you can see right here. So you can do the same. You type out previous week high right here. You note it on the top right or top left, whatever you would prefer. And then you do the same for previous week low, which we find on Friday. We can mark out the previous week low. And right here, we see the delivery of previous week. And if you want, for simplicity, you can, rather than being on the hourly chart, which I'm at right now, you can just go into the 4-hour chart and you will see it a bit smoother, a bit shorter right here. This is whatever you prefer. I want you to practice the hourly chart, reading it. So please stay on the hourly chart for the most of the time. Now, let's do the same on ES. We mark out, here's the current week. We mark out the previous week's high and low. And what do we see? I want you to pay attention to this right now. Let me just make this to the right as well. What can you see? We actually have an SMT right here. We see that NQ has heavily taken out the previous week's low right here. What do we see? This is the previous week's low on ES. Has it taken it out? No, we have made a higher low in regard to the previous week low. This would be one example. What I want you to do then, you don't just do this and then you go on to the next. You need to collect this. So on TradingView, I want you to, on the top right, find this take a snapshot. You either download the image or you copy the image and put it into your notepad. If you're using Notion, if you're using Google Docs, wherever you store everything, which I hope you're doing, you copy the image and put it into the chart. So this would be one example. So this is what you need to do for all of these time frames. You do it for weekly, daily, session, 90 and 30. So a 90-minute example would be just like this. You spot this, you note down the cracking correlation. This is a 90-minute example. This would be a daily example where we have a daily purge and revert, whilst the other one doesn't. So this is what you need to do for all these time cycles. So that will mean 50 in total. This means that you will do 90 examples of homework, and this will take its time. And by the end of this, you'll be amazed on how much clearer you can read the charts. So now, before we wrap up chapter 2, you should now understand and know the following. First of all, why we even look at time in the first place, what time looks like in the markets, which is of course the time cycles, and what those time cycles are. They should be natural to you. You should be able to remember them in an instance. What is each time cycle, okay? How opening prices work and why we look at them, what AMD is and how we utilize it, and what SMT is and why it is so important. And SMT will cover way more as well. But now this is what I need you to understand. And if you notice a pattern, when it comes to time and when it comes to our whole trading approach, we can always answer the why to why some things happen, rather than saying, oh, that just happened, I have no clue why. And it's because it goes back to the core concept of what we're doing. We are trading based on algorithms that are driving price. We don't believe in the typical buying and selling pressure. We believe that everything is rigged. Nothing is random. So now we arrive at chapter 3, which is about price. Until now, we have talked about time and the importance and significance of time in the market. We have went over the financial markets and how they work. Now it's time to start adding price to the equation. And price in the market is only looked at in two ways. We only look at price in terms of liquidity and in terms of market structure. So remember what we said in chapter 1. We only go to external liquidity, back to internal liquidity, to external, to internal, and so on and so on. This is the only thing the market does. So we move from an external liquidity pool, so again, liquidity, we move back into the range to an internal liquidity pool, which is something called imbalances, which we'll learn soon. And market structure is the reason we look at market structure is because that's how we confirm the order flow. And remember, the best trades are always in line with order flow. So when it comes to price is very simple because we only look at how the market is moving, and time is the filter that tells us when to look at what. So the first thing we will start talking about is intermarket relationship. Now, in the previous chapter, we talked about SMT, and the reason SMT works, or the reason the core to SMT is intermarket relationship. So now this is a bit of a more deep dive into the price aspect of intermarket relationship. So as we know, this is two correlated markets. What I mentioned to you before was NQES, EUGU, gold, silver, Bitcoin, Ethereum, right? When the markets are in a good environment, these markets will always move in sync. They will make highs, they will make lows at the same time. And why is this important? Well, it's important because this tells us when we have real SMT. This tells us what environment we are trading in. Because remember, SMT is a crack in correlation. Now just imagine for a second that the markets you're looking at for SMT are never correlated. You would technically find SMT all the time. You could frame a move or you could frame a crack in correlation on any given swing because it's always out of sync. And that means that we cannot look at those two markets for SMT. So we want to find the markets that are moving in tandem with each other, that are always or close to always making the same price moves. And now this is a bit of a more advanced thing, what I've written down right here. When one market makes CST, we want the other market to make it as well. When one market is in a sell program, we want the other market to be in a sell program as well. I want you to note this down because when you look back at it in a few slides or when we start talking about the more advanced stuff, this will all make sense. Because, and this is again, if you understand this very well, then you have understood a lot. When one market makes CST, we want the other to make it as well. Why? This means when one market goes from sell program to buy program, we want the other one to do the same. We want the same, or we want both markets to take out the same high. I'll show you in a second. So what does this actually mean? Well, let me write it out for you. So we have two markets that are moving in sync, okay? Like this, like this. We can write down ES and we can make this NQ. CST is the change of structure. We go from bearish to bullish. Where does that take place? This is our CST line right here. So the moment both markets take out this high, both markets make CST and go from bearish to bullish. Okay, what did I say in the slide? I said the moment or when we make CST, we want both markets to make CST at the same time. We want both markets to confirm the CST, the change of structure, together. Why? Because envision this, and I'll write it in blue. If NQ takes out this high, okay, it's gone higher, it's made CST, okay? CST has taken place. But in this, or at the same time, in the same time period, ES only reaches this level. It never reaches this high. What has actually happened? Well, until ES catches up, there's a crack in correlation between these two markets. Do you see that? Right there. Let me make it a bit clearer for you. So right there, we can see that we have an SMT, possible SMT, right there. And one thing for you now as well, since we start to get into the more advanced things, SMT only gets confirmed after we have CST. And we'll get into this way more detailed eventually. Just remember this. So the reason we want to see both markets make CST at the same time is because unless they do, we might have a possible SMT to do this, meaning that this was just a fake, and we can make a flag, a fake a fake CST. So this is something for you to pay attention to. Monitor the reactions to same highs and lows on both markets, how they get treated, what happens when a market takes out a high, in this case, was the other one doesn't. How does price react? Because you will see some amazing stuff. And the moment it actually catches up, because this might not be SMT, the moment it catches up, what happens here? You will be amazed. I can promise you that. So now I hope you understand why we want to see both markets take out the same highs and lows, especially in our favor, in our direction that we are looking at. And the best trade setups will come when everything between the correlated markets are fully in sync. And I hope you now can understand what this sentence means. Because when they are in sync, there is no possible SMT, no possible cracking correlation on the opposing side of our idea. So there's nothing telling us, okay, you might reverse now. Nothing is telling us that, because remember, every single reversal has SMT. That's just a fact. So unless there is something on the highs, some cracking correlation, there's nothing for us to worry about. And this is what we call environment recognition. There is something called environment selection, which has to do with time, with the calendar. And there is something called environment recognition. Okay? So remember this. And I hope with time we will start to see this live together. Let's look at some examples of intermarket relationship. Now I want us to determine whether a market or two markets are in sync or not. Not find SMTs, but find if they are in sync, if they are moving in tandem with each other. This means we want to see both go higher at the same time, both go lower at the same time. So let's take a look at the first example. Right here we have Nasdaq on the left, ES on the right. And I just want you to say, is this green or red? Meaning, are they moving in sync or not? Pause the video, pause the lecture, look at it and decide green or red. So let's take a look now. And if you didn't pause, do so now, because now I'll show you. And this is a green example. This is a period when both markets are in sync with each other, okay? We see that NQ makes lows right here, lows right there, highs right there, highs right there, at the same time that ES does. These are moving in sync. They are equal. They are doing the same thing. Obviously, they might not do the exact same size in comparison to each other, but they are moving in sync. Higher highs, higher lows, lower lows, lower highs. That's the definition. Let's take a look at another example right here. And what we can see right here is NQ on the left, ES on the right. And I want you to determine, are these markets in sync or not? So take a look here, see what you can decide or what you can see for yourself, and tell me, is this red or is it green? So pause this lecture now. I hope you paused, because now I'll show you the answer. So right here, we can see that the markets are not in sync. Why? So pause again, and I want you to think about why they are not in sync. If you answer they are not in sync, good, but I want you to define why they are not, because we don't want to guess this. So pause this. So what we can see, and I hope you paused it. I'm amazed by some people who never pauses these lectures, but that's another topic. What we can see is that on Tuesday, NQ goes lower. What do we see on Tuesday on ES? ES goes higher, and then it goes sideways. So already on Tuesday, we can see that one market is lower, one market is going higher. On Wednesday, we see that initially both markets are standing rather still, okay? And then we see ES go higher whilst NQ goes slowly lower. Again, not in sync. And then we see one push lower right here on Wednesday, which both markets make. But what do we see happen on Thursday? On Thursday, NQ goes higher, ES goes lower. Again, not in sync. So this means that we can frame a lot of SMTs, but we don't know which market is lying. That's why we cannot trust it. So this is an example. If you compare it to this and look at this, you can see that it's not in sync. I hope that you can start to see this. And this is, again, environment recognition. This is something you have to start to see live. Start to recognize, oh shit, that market is going high and this one's going lower. We have to be careful. We have to pause now. We have to think, should we engage in this? Because the truth is, you don't know which one is lying or not. You don't know if NQ that's going higher or ES that's going lower is telling the truth. And until you can know which one is telling the truth, you don't want to be on one side of the market, because you're basically gambling. So now let's move over to some actual price patterns, some actual things we monitor on the charts, in the charts. And the first thing here is called imbalances or fair value gaps. We have bullish fair value gaps, bullish imbalances, we have bearish imbalances, and we have the inversion fair value gap. This is when a bearish fair value gap turns into a bullish one. So this is a 3 candle pattern, okay? We have candle 1, we have candle 2, we have candle 3. Same goes here. We have candle 1, candle 2, candle 3. And the key here is to monitor what happens in between them. We can see that the high of candle 1 is right there. We can see that the low of candle 2 is right there. And candle 3. And candle 2 didn't wick neither side. So we can see that it's a gap, an open gap to the body between candle 1's high and candle 3's low, symbolized and shown by this arrow and this green box. Okay, on the other side we can see a low of candle 1 right here. We can see candle 2 strongly closing lower. We can see candle 3 with its respective high right there, and we can see the gap in between these two markets, which creates the fair value gap. This can also be called, and this is what I will call it moving forward, BISI is the bullish example, BISI. Bearish example is called SIBI, SIBI. So the BISI stands for buy side imbalance, sell side inefficiency. A bearish fair value gap, a SIBI, stands for sell side imbalance, buy side inefficiency. Because this is our internal liquidity. Starting to make sense now? This is what in the first chapter, when we talked about external to internal liquidity, these are our internal liquidity pools. Inside these boxes, the shadowed boxes right here, there's a lack of liquidity. There's a lack of sell side liquidity inside of these boxes. Through this whole candle, we have buy side that's pushing price, that's taking this candle, right? And then there's a lack of sell side. This is sell side, the open low, but it lacks sell side in between here. So this is an internal liquidity. Does it start to make sense? It's an imbalance of delivery. We want to see equal deliveries all the time. So this is why we look at these imbalances and what they mean. And an inverse fair value gap, EFVG, is basically when we go from bullish, we make CST, we turn that into resistance. So this is what we will take a look at right now. The only thing I want you as well to remember, because right here we can see it's a 3 candle pattern that we just looked at. But the thing I want you to remember is that an imbalance, what it actually shows is strength in one direction. It shows displacement. Okay, so whenever I say displacement, it means strength. It means imbalances are being created. This shows that we are strong to one direction. Okay, so once you start looking at your own chart, I want you to find the imbalances that price has repetitively reacted off and keep them on the charts. Because what you can do is you can take imbalances from the left side, so from your left on the chart, and you can drag them to the right. Because there are real imbalances and there are imbalances you will see that has no effect on price. Because what you'll see, there are key levels in the market where price keeps bouncing off of. So you want to keep those levels on your chart. Okay, so these are the ones that are used as the point of interest, POI. Or it can actually be your target, your drawn liquidity, if you're taking a retracement trade. If you're trading from an external liquidity, you take the trade back into internal liquidity. And like I just mentioned, the reason they work is because imbalances has to be filled to become balanced. They have to be balanced in the amount of delivery that's been at that specific price. In a busy, we have a lack of sell side, hence why when we drop lower, we create sell side, and then we can go back again. This is something that you will start to realize when you start looking at the charts, which is a very common confusion, right? Is which fair value gap do you actually look at and use when you see multiple in a row? And as I said right here, you always want to refer to the ones from the left that price has referred to multiple times before. So this is because multiple imbalances in the same area, which you will see, you will eventually start to see one imbalance all the way to the left, and then you will see multiple imbalances within the same area. That's a key reference point in the algorithm, in the market, and a key level. So you have to monitor and keep those levels on your chart. Let's take a look at an example. Right here, I want you to pause this, but before you do, I need you to understand what to do. I want you to find every single imbalance that you can see on this chart. Screenshot it and mark all of them out. There are a lot of them, so I want you to mark them out. So pause it now and do the exercise. I hope you paused it because now I will show you. So what can we see? Here are all the imbalances that we can spot on this chart. You see one right here, and I will extend them in a second, but you see one here, low, displacement, high, creates an imbalance right there. Same goes there. Here we can see two in a row. Here we see a smaller one. Here we see a very small one. I hope that you can see it on the recording. Here we can see one here, 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 and there, there, there. So now pause the lecture again and compare it to what you wrote. Which one did you have right? Which one did you have wrong? And I want you to recheck your previous chart, add the ones you missed so you can practice your eye. So do that now before we continue to the next example, or to when we extend the chart. So now what we see is the exact same chart, this chart, but now I've extended all of these imbalances to the right. So what I mentioned was we refer to the ones to the left that price keeps referencing. We see an imbalance being created right here. And you see it first reject this level right here, and here at this moment it becomes an inverse fair value gap, an IFVG. Right here price keeps bouncing off this level still. It rejects it, treats it as support, and continues higher. Here you can see it another time. Here we see another imbalance being created, and what we see is that it keeps treating it as resistance on price right here, and here we see another one. We can see two being created, and you see price keeps bouncing and working around this level. And right here we see a big drop, and this is one for your notes. When we see the final manipulation leg, you want to see a big imbalance being created. This is eventually your inverse fair value gap that you want to take the trade off. So I hope you wrote that down, because this is the magic. When we take out a PXL or PXH with an imbalance, reverse it, treats it as support or resistance, that's where the magic happens. So let's now move on to the other type of structure or pattern we are looking at in the markets. And this is called breaker blocks, okay? A breaker is basically CST, where CST occurs. So we have a low, we have a lower high, lower low, we create a higher high. The previous lower high is our breaker. We then retrace back into it, making a higher low, treating the previous lower high as support on price to continue. On the opposite side, we have a high, we have a higher low, higher high, lower low, lower high, treating the previous higher low as resistance on price to then go lower. So the last down close candle before the final run higher is a bullish breaker, and the last up close candle before the final run lower is a bearish breaker. Note that down, and we'll take a look at what this actually looks like in the chart. What I just mentioned is that the breaker confirms the CST. That is where our CST line is. So there is always a breaker in every change of structure. In every market maker model, MMXM, you will see breakers form. And I'll cover as well the most powerful combination when it comes to entry pattern, or more importantly, reversal patterns, which is the imbalance plus breakers. So let's look at a chart example. Do you remember what I said? The last down close candle before the final run higher is a bullish breaker. The last up close candle before the final run lower is a bearish breaker. Now, this is an example where we went from lower to higher. So I want you to find what? The last up close candle before we make the final low. So take a look right here. Mark out the last up close candle before the final lower low. So I hope you pause the video because now I'll show you right there. What we can see here is that we have a low all the way here. We make a high, we make a lower low, and then we make a higher high. Higher in regards to this previous lower high, creating our breaker. Because what did we say? The last up close candle before the final run lower, the last up close candle, the last green candle before the final run lower becomes our breaker. And you see how price keeps respecting this level. So I hope that by now you understand what an imbalance is, how it looks, and what a breaker is and how it looks. So let's take a look at the duo that I mentioned right here. What we see when we see imbalances plus breakers form, because that's where the real magic happens. Because what we want to see is that the breaker forms inside the imbalance to the left, makes the final manipulation leg lower, displaces above it showing strength, and now we have an inverse fair value gap to the left, we have the breaker in the middle, and we have a fair value gap to the right. And what can we see right here? We see a low, higher low. Where does the higher low form? Inside this CB to the left. Do you see it? We make a lower low compared to this low. CST occurs the moment we take out this high, this area. And what do we see happen? Here, we reject the lever perfectly. Have one final retracement, make one more leg higher. And what happens right here? We create a busy through the previous CB and the breaker. Why is this so important? Because this now shows strength, displacement. What did I tell you about displacement? I said that displacement shows strength in the market. So this pattern is also called the market structure shift pattern. And I want you to note it down, and this needs to be printed into your eyes. They need to see it within seconds, because this is where the magic happens. When you see this at a reversal point, that's when the true reversal takes place and where the market will just shoot in your direction. And now we covered the final thing I want us to look at when it comes to rejections, reactions on price. And this is PXH and PXL, which we have already covered, but now we focus on it as price. Because if you remember in chapter 2, when we talked about time, we said that only two things could happen, okay? We either purge and revert a PXH or PXL, or we use it as support and resistance to then continue in the direction. So this means that we can extend all of these levels to the right to monitor how we react of them. We always monitor the reaction to those specific levels, and you will start to see what happens, how we react of it, and what we can learn from that. Now, the most important thing here, which you will be looking at a lot, and which I want you to start paying attention to, is when we form an imbalance through a PXH or PXL. These are the most important reference points you can have on your chart. Why? Because what you'll see is these are the true support and resistance, or these are the final manipulation legs you will see. So please mark out these highs and lows, mark out the imbalances that form through these levels. And this is an example that we looked at previously. We see cycle 1, we see cycle 2, open, low. We see cycle 1 clearly reject PXL, previous 90-minute cycle low, and reverse to the upside. So again, if we extend this line to the right, we see a clear rejection taking place. Now, what I also want you to understand is that the more advanced we become, we can zoom into this whole delivery and we will start to see things happening inside here on a smaller time frame. Let's look at another example. And what we see right here is, again, cycle 1, AM1 right here. We see that the market takes out AM1 and we can either choose to extend the whole line just as a line like this, or we can extend the last or the up close candle, the highest candle, which I've done here in pink. And what do we see? First of all, we see price having a hard time at this level. Eventually we close above it, retrace back into it, treating it as support on price, and we extend and expand further to the upside. So I want you to start paying attention to this, because what you'll see is that everything in regards to PXH and PXL, that's where the real magic happens. The patterns that I mentioned here, they are always, or most often, and especially the strongest one, are all in relation to these levels. Okay? So now let's move on to CST. And by now I hope that you have understood kind of what CST is, because CST is the change in the state of delivery. It's the point that we switch programs, and program means we go from bullish to bearish, from bearish to bullish. So this can also be defined as order flow is being switched. Okay, we change targets from lower to higher. And when we take our reversal trades, right, because that is what we focus on, we always have to wait for the CST before we can enter. Why? Because that's when we know we have gone from bullish to bearish, or bearish to bullish. So here's a visual example of CST. We make higher highs, higher lows, higher highs, higher lows, higher high. The moment we break the previous higher low, we make CST. This can be symbolized by a line crossing to the right side of the curve, showing CST, and now we can start anticipating lower lows, lower highs, lower lows, lower highs, until the next CST. So, as I mentioned as well, every CST consists of a breaker formation on some time frame, because what you might start to realize, again, the markets are not perfect, right? Because what you'll start to see is sometimes if you look at the chart on a 1 minute time frame, you might not see the breaker formation, and you're like, why did we go from higher to lower? If you zoom into, let's say, a 15-second chart, where every candle represents 15 seconds of time, you will see the pattern there, or even on a lower scale. So this is something to remember as well. That's why we always have to be fluid with how we look at a chart, fluid with what time frames we look at, and we'll cover this as well. So the pattern, or the objective definition of CST is low, lower high, lower low, higher high. That's the moment CST occurs, symbolized with this red arrow, and then we make a higher low. On the flip side, high, higher low, higher high, lower low. This makes the CST change of structure, change in the state of delivery, and then we make a lower high, which is exactly the example we see here. We see high, follow along here, and follow along here. High, higher low, higher high, we make actually this twice. So high, higher low, higher high, higher low. Now we are here, higher high right there. And the moment we break this, we have made the lower low, CST right there. And then we will make a lower high. So let's look at an example. And I want you to pause this when I tell you to and tell me where CST occurs. Only look at CST. Remember, this is how CST is defined. So where can you see us go from bearish, meaning from... So where can you see us go from bearish, meaning from low, lower high, lower low, and then where do we make the higher high? So look at this, pause it now, mark out with a line like this where CST occurs. I hope you paused because now I'll show you. And right there we can see it. Okay. I hope first of all that you got it right. If you didn't, then listen along so you can understand why. What we see here is we see first of all a high, low, higher high, lower low. So now a bit more advanced, and maybe this is too much, but we make CST there to the downside as well. Okay, but let's focus here where we go from bearish to bullish. We make a low, you can say low, high, low, or you can say low, just this straight line. We make a lower high with this high. We make a lower low right there in regards to this previous low. And we make a higher high the moment this candle closes or even taps this high. Why this high? Why not this or this or this? Well, on this scale that we're looking at, you have to envision it like straight lines. If we go back to the Miro board, what we saw was the following. We saw a low, we saw a high, we saw a low. Now within this one, do you remember the markets are fractal? We can see all of this type of delivery, okay? Which is what we saw. If we go back, right here we see one low, high, low, high, low, low, high, and so on. And then we make this. So within this whole leg, we can see something like this. But when we look at CST on the bigger scale, it has to be at this high. Makes sense? Because now if you have understood things rather quickly, what you will understand here is that we can have a fractal, meaning a smaller CST within this tinier range when we make this. And we might go higher, but the bigger CST occurs here. So what this CST confirms is that we'll go bullish at least a bit more, somewhere here. And when we make the bigger CST with this one, it confirms that we'll go even higher. Does it make sense? Let's go back to the image. We have one straight line, straight up, down. So this is our bigger CST confirming we'll go up here, which we eventually do. Now, if we zoom into this delivery, we will eventually find smaller and earlier CST happening right here, confirming that we'll go higher, but the bigger one occurs here. So this is when we look at time frame for time frame, we zoom in, we zoom out to understand the full picture. Because if you remember in chapter 1, I said something. I said we want to engage in the trades where every single person, in this case, every single time frame tells the same story. That's when you know you're on side and you will be part of the right move. Let's now take a look at another example. And in the previous one, we looked at where do we go from bearish to bullish. Now I want us to take a look at where do we go from bullish to bearish, okay? So pause this video now, make the line just like this, where the CST occurred, and then let's look at it together. So pause it now. I hope you paused the video because now I'll show you. And where we can see the CST from bullish to bearish is right there. We see higher high, higher low, higher high, higher low, higher high, And this is our previous higher low. So the moment this gets jagged, the moment we reach this low, we have officially made CST right there, making a lower low compared to this. And then we go lower from there. I hope you can start to see it and understand it. And this will of course become your breaker point, where the breaker is formed. And now we move on to the next term, the SMR, which stands for the Smart Money Reversal. The SMR is actually very simple in what it actually means. It's the absolute high or low for a swing. Now, what I told you before, envision the high or low and the reversal like a dish, like a cake. For a SMR to be formed, certain ingredients needs to be present to confirm it. You don't just guess when we have a high or low. And this is what creates the level of precision that you achieve, or that you can be able to achieve with this way of looking at the markets. Because what every SMR needs to have, what it needs to consist of, is a point of interest. I want to look right here. Point of interest needs to have an SMT and it needs to have CST. We'll cover this more in depth in chapter 4. So for now, just remember that the SMR is the absolute high and low, or high or low of a swing. So if we fractalize this, this is a internal or a fractalized SMR. Here you could find a fractal SMR. Here, 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 here. All of them, if we zoom in deep enough, we'll see the same pattern, the same ingredients happening over and over again. And this is the beauty. You'll start to notice it soon. So now I wanted to mark out where do we have the SMR on this whole bigger range, or this whole bigger move. So from this low to high, where is the absolute low in this case? So I want you to pinpoint that candle or that line. So I hope you pause the video, because now I'll show you. And what we can see is that this is the SMR on this candle, on this time frame. But if we zoom in, the absolute SMR will be right there at the bottom. So let's now look at the point of interest, which we covered earlier on in chapter 1. Let's now talk about it more in depth, because the point of interest is where we want to take the trade from, where we want to take our trade from. It's where are valid levels that price can reverse from. Because what I want you to understand, and a big misconception many traders have, is that they start pointing out the imbalances, the breakers, the PDRAs as it's called. And they think that the market will reverse on all of them. What I want you to understand is that a point of interest is no magic. And we don't know yet beforehand if something will happen there or not. But it's inside the point of interest. When a market reaches a higher time frame point of interest, we start to hunt and look and monitor on what happens inside it on the lower time frame. This is the key. And as we talked about in chapter 1, the best and ideal point of interest are within premium and discounts of the ranges, right? Of where we retrace. We want to retrace back into minimum equilibrium. So we always refer to the left side of the curve as well. We always refer to what has happened on the left to determine what will happen on the right. You will see that what happens on the left, the delivery of price, whatever happens there, will always affect the right side and what will print in the future, because these are algorithmic reference points. Just note that down. What you will hear me talk about a lot is higher time frame point of interest, right? The point of interest is always something you choose and look at on your higher time frame. Remember what we talked about? Your higher time frame can be whatever you choose, but the way we trade, the higher time frame will be the hourly. So you look at point of interest on the hourly chart for the most time. And examples of point of interest can be imbalances, it can be liquidity levels, it can be breakers, and it can be the MSS, the market structure shift pattern. So let's take a look at how this looks, what we can see on the higher time frame, and when we zoom into the lower time frame, the 1 minute chart, what we see taking place there. So here we have a high, low, high, low, high, breaking structure right there. So now we want to look for shorts. We want to continue the downtrend. So we wait for a retracement higher to go short. And what do we see happening right here? We see a busy, we see a low, creating the breaker, high, lower low. What happens here? We see a SIBI through this level, creating the MSS pattern, the market structure shift pattern. We retrace back into it. Now we zoom into what happens in this hourly wick right here. This is the 1 minute chart. We see that the market comes into it. We go up into it aggressively. We manipulate higher, reject this point of interest. You can see this black line is this breaker. You can see the imbalance, or sorry, the busy, the inverse fair value gap right here. And this is our SIBI. We reject it and boom, the market just shoots lower. Let's look at another example. Here, our point of interest is a breaker. We make a low, we make a lower high, lower low, and right here, we break this. Here, it looks like it's equal highs, but here we actually break structure, making this our breaker. We retrace into it, and again, this is not the cleanest example, but you can see that we are coming into it. So what we are saying when we look at this is, as long as we don't displace below this, we will form a low within this level, within this yellow box. And here we can see the 1 minute chart where exactly that happens. We retrace, or we manipulate lower aggressively right here, and then we reverse right there, expanding higher, that you can see right there. So now I hope you understand what a point of interest is, what it could be, and what we do, how we actually use it. That's the most important. We don't just say the market will reverse there. In every point of interest, every possible point of interest, we monitor what happens inside of it. Okay? So let's now go over the opposite of point of interest, the draw on liquidity. This is the market's magnet, where it is drawing to. Envision it like if we have higher drawn liquidity, there's like a magnet. We have to get to it. The market is just taking us there. So we will eventually just keep going higher. And the drawn liquidity is always a higher time frame level that we're going to. And always or most often, it's always a time-based level. Okay? We use this to know and anticipate the order flow. Does it make sense? What I mean by this, and we'll take a look at a chart in a second, is if we know that the market is going higher, the drawn liquidity is above us, we need to get to this level. We can anticipate that we will have bullish order flow, bullish market structure. What does this mean? It means that we make higher highs, higher lows, higher highs, higher lows, only until we reach the drawn liquidity. Why is this so important? It's because then we can be on the right side of order flow. We can sit and ride the boat. So we wait for every retracement to go higher. And here I've written something that is very important to note down. Without a higher time frame drawn liquidity, without a higher time frame bias in price, we will be lost. We will not know where the markets will go. And this is crucial, because once you start to trade yourself, you will see that the best trades, the best setups, the easiest setups will be when you can clearly within seconds say where we are going, where the draw on liquidity is. So once we have a clear liquidity, we'll always be able to anticipate that drops against our drawn liquidity will be reversed, and that the drops are purely manipulation. And this is how we catch the trades, just like I told you. And once our drawn liquidity is reached, this is important. We do nothing, because once we have one, the market has to create new liquidity. It has to make something new for us to target. So if we can't determine our drawn liquidity, we stand still. We do nothing. And this, with more time, with more experience, with more burnt hands, you will understand the value of this. So let's jump into an actual chart. This is our draw on liquidity, okay? This is the previous week's high. You can see it's Thursday. Now we're on a new week. So this is our draw on liquidity. This is our magnet. What did we say about draw on liquidity? So we can anticipate the order flow, how the markets will move at or towards this level. So look now. Right here, we looked at it from Tuesday, Wednesday. Now by Friday, we have reached this high. What do we see taking place here? The markets keeps making higher highs, higher lows, higher highs, higher lows until we reaches this level. So we don't need to be scared at any retracement here, at any drop. We don't need to be scared because we know that the market has and will go higher. Does it make sense? Look at the next image. Here I've written down with lines the exact same price delivery we see here. Notice how we never make a lower low. Here, look, here's the previous higher low. Here we make a higher high. And what we see is the following. We never make a lower low compared to this low. We can make an equal low. We can be as close to it as possible, but we don't make a lower low, breaking structure, telling us we are bearish because order flow is bullish and we are drawing towards this level. So this is how we can anticipate moves in advance, how we can anticipate when something is a reversal, retracement, expansion, and so on. Starting to see how we put all the things we have learned together, and we'll do this even more soon in chapter 4. But what I need you to understand is that everything we have talked about might seem confusing, might seem, oh shit, what is he talking about? He's already mentioned it 100 times. Everything is like a small puzzle piece, okay? And it doesn't make sense, it doesn't help you until we put everything together. Trading, the way we are trading, the way this works, it's like a story. You're telling a story. And if the story isn't complete, you cannot tell a story, of course. The definition of a story is you have to start it and you have to end it. If you cannot end it or if it breaks in the middle, it isn't a story anymore. It's two separate ones, right? The same goes for our analysis in trading. We make a story in our trading from inception, from A to Z. Everything should add up to what has been said previously. And with more time, with more experience, with more chart time, you will start to see how this plays out time and time again. And when you don't know the story, you don't trade. You cannot trade because you don't understand what's happening. And you not understanding what's happening isn't a skill issue. It's not something you can do about it. It's that the market has to wait until it can create a new story for you. Because if there were so easy that there was a story every single time, I think everyone would be a trader. Everyone would be a multimillionaire because it's so easy to trade. There's always something to do. There isn't. And you will learn this with. Now, before we wrap up chapter 3, here is the homework. The first exercise and homework is collect 20 examples on the 1 hour chart where the market reacts off a breaker. When it on the hourly chart drops into or drops up to that level, drop into the 1 minute chart and see what happens there. Take the screenshots of both examples. So you have an hourly example, you have a 1 minute example. Just like we did here. Screenshot 1 would be this one, hourly breaker. Screenshot 2 would be the 1 minute chart showing the rejection inside this level. Second example is I want you to do the exact same with the imbalance. You mark out an hourly imbalance, see where we reject it, you drop into the 1 minute chart and see what happens inside of it. Take the screenshots, so you have 2 screenshots, exactly same as exercise 1. And the third example, I want you to collect 30 examples on the 1 minute chart where you look at a random price action. You mark out the highs and lows that both markets take. See how once one market takes the other one, whilst the other one doesn't, what happens? If one is lagging behind, and what happens the moment the other one catches up? And this is the goal. This is the intermarket relationship that I talked about earlier. So if you forgot what that meant, please go back to that chapter, that part in this chapter where we talked about intermarket relationship, and you will see exactly what I mean. This will give you so much clarity when you're trading. This is how you can flow with the market. You can anticipate things, and you can become it's just like a fish in the water. You're just flowing with the stream. If it's going forward, if it's going backward, you're just chilling because you understand what's going on. You don't try to fight and swim forward when the flood and the stream is going backwards. That is not what we're trying to do. We just want to flow with the market, okay? So this is the key. And I've written here as well, have the time cycles on. I want you now, because now we start to get more advanced. I want you to start working and paying attention to time cycles, viewing them. They should become second nature, time cycles. And I will link the indicator to the time cycles that I'm using in the description. So just go into the description, find it, and add it to your TradingView chart. That way you don't have to manually mark it out every single time. So just do that. You'll find it in the description. So now we're at the end of chapter 3, right? And after this, we'll start to put everything together. So it's very important that you now actually genuinely feel like, okay, I almost understand everything. You shouldn't understand 100% because that comes with putting things together, but I need you to understand the core things. So you need to understand what an imbalance is, what a breaker is, and how in price we utilize PXH, PXL. You need to understand what intermarket relationship means, how we look at it, point of interest, drawn liquidity, CSD, and SMR. You also have to remember and understand what time cycles are, what SMT is, AMD, and opening prices. So if you don't understand this yet, go back to the parts you need to re-listen before you move on to chapter 4, because now we'll put everything together. This is where the magic happens. This is where all your aha moments will come, where all the light bulbs will just click, where everything will be, we add this plus this plus this equals this. So please make sure you do this seriously and properly. That's how you will learn the best. Let it take whatever time it needs to take. Now we have arrived at chapter 4, putting it all together. And it's now the fun actually starts, because all the pieces, all the things we've talked about, been going over so far, will be added into a sequence and a puzzle. I want you to think about every single thing we've talked about today as a piece of a bigger puzzle. And now we'll work on setting the whole puzzle together. What you will realize is that everything revolves around market maker models, MMXM. And this is where the fun and interesting starts to happen. So get your notebooks ready and let's dive in. The first thing we have, and what we will talk about a lot right now, is market maker models, MMXM. Because every higher time frame expansion, so expansion, retracement, expansion, is a lower time frame market maker model. Expansion, retracement, expansion, there you will find a market maker model. And we have a bullish and bearish example, market maker buy model. Then that is MMBM, you change the X. We have bearish example, MMXM, where the S comes in. An MMXM, or a market maker model, consists of two sides. We have the left side of the curve, we have the right side of the curve. And they are separated by the SMR. And here's where the SMR will start to make sense. That is the midpoint from left side to right side, where we go from sell to buy, where we go from buy to bear, buy to sell. So once the SMR is in, algorithmically, A to B is in, and we have to reach the original consolidation. Will make sense in a second. If you're right on your idea and the SMR is actually in, we will never reach the SMR again. Do you understand what this means? You can start to say that we will never reach a certain level, so you can take a trade to the other side of that level. The left side of the curve always impact and influence the right side of the curve. You will start to see that whatever happens on the left will happen and impact whatever happens and will happen on the right. And another thing is that the left side of the curve that you are trading is actually the right side of the curve of another market maker model. So now we'll go over all of this with visual representations and in a very deep way, because this is where everything happens. This is what everything revolves around, where everything will be about. So please make sure that you are ready. So first of all, I want us to pay attention to how a market maker buy model works. What is the actual schematic of it? And this is how it looks. We have the original consolidation. We have the first stage of distribution, second stage of distribution. We have the SMR. We have the low risk buy, first stage of accumulation, and then we have this target. Here you can also see the higher time frame drawn liquidity. We can see the higher time frame point of interest, and we can see these two curves. What this is, we have the left side of the curve, which is separated by the SMR. We have the right side of the curve. Let's look at a bearish example. Here we have a market maker sell model. Here we have the original consolidation. We have the first stage of accumulation, second stage of accumulation. We have the SMR in this yellow box. We have the low risk sell, this red box. We have the first stage of distribution. Again, we have the higher time frame drawn liquidity below us. We have the higher time frame point of interest, where the SMR takes place from. And we can see the left side of the curve all the way from original consolidation to where? To the SMR. We have the right side of the curve all the way from the SMR to our target. So let's look at what this actually looks like, because what did I tell you? Every higher time frame expansion, retracement, expansion is a lower time frame market maker model. Let's look at an example. We have expansion, and this is on the hourly chart, our higher time frame. We have an expansion higher, followed by a retracement lower, followed by an expansion higher. Where can we find our market maker buy model? Inside this box. So let's jump into the lower time frame and see what it looks like. This is the exact same chart, okay? Exact same chart on a lower time frame that we can see right here on the higher time frame. And if you look at how this looked, what can you see right here? Here, don't mind the distribution, it should say accumulation, so just first stage of accumulation. Here is the inception. This is called inception of the move. This is called the terminus of the move. Okay? A to B, A to B also. Here we have the original consolidation. This is where the market is accumulating, where the market is starting our move. We then start to drop lower, and this is our first stage of distribution. The first kind of pause in the move lower. We then make the quick drop, the open low into and creating our SMR. We then reverse, and from this point onwards, from this wick, we are only going higher. So now we expand higher, retrace. This is the first buying opportunity called the low risk buy. Here is the second consolidation, the second kind of pause, you can say. This is called the first stage of accumulation. And then we reach the full target, in other words, the original consolidation. So this is how it looks. I hope by now you have understood that time is way more important than price. So when we look at market maker models, we only look at them in regards to time. So let's look at this exact example, but with the time cycles added. What does that look like? We can see the following. We can see that we have an AMD on the sessions. Do you see that? We have the accumulation on London, London 1, London 2, London 3. We have AM, open, low, creating the SMR. And then we have PM creating the final leg of distribution to take out our original consolidation. Okay? So do you see how this expansion, retracement, expansion looks like this on a lower time frame? And why is this so important? What makes me confidently say that the market maker models is everything? It's because the only thing we are doing when we are trading is we are trading reversals in line with the higher time frame order flow. So we know that the market has to continue higher. We just wait then for a retracement lower. Look at when the retracement is done, when the SMR is in, to then continue to the upside, because we know that the magnet, the drawn liquidity, is higher. Remember what we looked at in chapter 3, in the end of chapter 3. We know the market has to go higher, so we can just continue in that direction. And that is the importance of this. So do you see how this is the exact same chart, but with the time cycles, we see it way clearer. We can see how the time cycles actually create an AMD within this market maker buy model, because all market maker buy models are AMD, accumulation, manipulation, and distribution. That's it. So let's look at another example of how a market maker model could look. Again, we have expansion higher on the hourly chart. So this is the expansion leg. We have the retracement with these two black candles, and then we have another expansion. Before I show you, where will we find a market maker buy model? So pause this lecture and tell me where. This is our market maker buy model. Do you see? Here will be the start, the original consolidation. Here's the retracement, the left side of the curve. The SMR is right here, setting up the move, and the right side of the curve to target the original consolidation. Do you see how we can see what will happen inside the lower time frame on the bigger time frame? That's why I'm so heavy on seeing this, on studying this, on practicing the eye. So let's take a look at how this actually looks on the lower time frame. This is the exact same chart on the 1 minute chart that we saw right here on the hourly chart. What do we see? We see the OC, which is shortening for original consolidation, the start of the move. We see the first stage of distribution right here. We see the second stage of distribution right there. We see an aggressive open low right here. Do you see? Very aggressive in comparison to this. Open low. SMR is forming right here, followed by CST right there. We then see the low risk buy occurring right here, which is the expansion retracement, and then we expand from there. Now let's look at it from the lens of the time cycles. And what we can see is that this is a 90-minute cycle AMD. Do you start to see how it's all adding up, how everything is connected together, and how beautiful it is when we actually understand what's going on? Because what do we see? We see AM1 accumulate. Here we have the original consolidation. We see AM2 open low. What happens at the SMR? Here we didn't really see what happened. When we look at it this way, we can draw a straight line like this and see how we reject the previous cycle low. If we zoom in right here, we can see that we displace through previous cycle low with an imbalance. What did I tell you when we looked at imbalances? The ones that close below PXL, PXH. This happens, we see a lower time frame CST occurring right here, but if you don't want to engage right here, we see the real bigger CST right there. We retrace once again, and right here is the low risk buy, and we continue to the upside. Now what is the beauty? AMD. Yes, we didn't finish the move in AM3 in the distribution phase, but again, what did I tell you before? The markets are not perfect. It will not finish exactly at 11:30, right? But what we see is that the next cycle just shoots higher. Why? And remember when we talked about openings, we talked about this. When the low or high is already in, we know that the SMR is in here. We know that AM3 will just distribute higher. And when we know that we haven't completed the market maker buy model and there's no reason for us to reverse lower, we can anticipate that PM1, so from 11:30 onwards, will open high into our target. Do you see how we are adding every piece together slowly but surely? Let's now look at a bearish example of the same thing. And now we add point of interest, okay? So, first of all, we see expansion lower. Monitor this, all of these black candles, unclosed candles, but mainly these two. We then see a retracement higher, where? Into a hourly / higher time frame point of interest, and then we expand lower. So where can we find our market maker model? And more importantly, our market maker sell model. So we can see it from this start right here. This is our original consolidation. This is the SMR, and this is the right side of the curve. And this, with this 1, 2, 3, 4 candles, creates the market maker sell model. Let's jump into the 1 minute chart and see how it looks. This is what it looks like, okay? And if you remember, we reached this hourly point of interest. We'll take a look at this in a second, how it looks with this one marked out. But for now, let's only look at the market maker sell model as it is. We see the original consolidation right here, start of the move, mainly this candle. We see price going higher. Here we see the SMR forming. Where is the SMR? It's exactly at the high of this candle. So this candle is our SMR. We then see market making CST, going lower, retracing where? If you take premium to discount, you will also see that this is in 50% of the high here to the low here. I didn't mark it out. You see us reject this level, continue lower. Here is the first stage of distribution, and we then reach the target. Let's now add some more lipstick. Let's put on the time cycles, and let's look at the hourly point of interest. And what we can see now is that this is what it's currently looking like. This blue shaded box you just saw is these two lines, our hourly CB, as you can see right there. The time cycles, you can see that this is AM3, 10 to 11:30. This is PM1, which is 11:30 to 1. So what do we see? We see an AMD in regards to these three 90-minute cycles. So this is not a golden example. What we see here is actually the third distribution cycle being the accumulation. The first accumulation cycle being the manipulation cycle. And this can happen. So we need to learn and adapt when the market does what it's doing. So what do we see? We see the accumulation here, right? We open high, immediate open high at 11:30, manipulating, creating the SMR slightly above our CB, which is completely fine. Why? Because this is an hourly imbalance. So as long as the hourly candle doesn't close above it, we can wick above it. That is completely fine. Because the bodies tell the story and the wicks do the damage. That is something for your notes as well. So we can allow for price to go above as long as the hourly candle, which in this case closes at 12. This is the 11 a.m. candle. So as long as it doesn't close above it, we expect price to reject this area. And what do we see? We see the rejection taking place, strong snap lower, retracement back into the point of interest, but also back into previous cycle high. Do you see? We have opened high aggressively. The moment we close back below previous cycle high, we want to see it act as resistance on price. You can see how perfectly we are rejecting this level, and then the market goes lower. Here, the market is doing something that is called engineering liquidity. We are engineering more liquidity in advance of a point of interest or drawn liquidity. And then we see the market retrace. People think, oh, wow, we have support down here. But we know better. The market just makes one high and then one final high at the new opening, tricking even more people, engineering a lot of liquidity to then go lower. So now let's up the notch. First, I'll show you one raw market maker model, and then we'll start to add even more lipstick. even more things. And then we look at it live together. We look at a few examples because this, you really need to see it with your own eyes. I want to walk it through with my own perspective, and I want you to just follow along because again, market maker models contain all the things we have talked about. So it might be that I've missed something, which I hope I haven't, but when we look at it live together, you will start to see things and you will have to look at what I will talk about over and over again, and you will notice things that maybe you didn't hear the first time. Let's now look at this naked chart. This is a market maker buy model. And what I want you to do is mark out, first of all, you need to pause this when I tell you to, but I want you to mark out as much as you can, as much as you have understood. Okay? So don't feel any pressure. Mark out whatever you can understand. Okay? CST levels, imbalances, breakers, the SMR, the left side of the curve, the right side of the curve, which is already technically marked out. I want you to mark out as much as you can think of and what you think has significance. And then I'll show you the lipstick. So please go ahead and pause the video now, take your time, really take your time, and then let's look at it together. I hope you pause because now I'll switch to the lipstick chart, okay? And this is what it looks like. A lot of things on the chart, yes. So let's break each thing down. First of all, we have the time cycles. Here we have AM3, we have PM1. We see that 11:30 is right there, and we can see this right there, okay? We see 11:30 right there dividing these two cycles, right? And I've marked some things out for you. So let's go over from the start of the left, from the original consolidation, and walk it through to the right. What can we see? First of all, we see we see the original consolidation right here. And the market continues lower. Now we are purely, and keep this in mind, purely paying attention to the 1 minute chart. With the higher time frame, it would be clear why we would go higher, but we'll cover that in a future example. So here I've marked two things out. A horizontal line, this black line, and we have marked out this blue shaded box, this SIBI. Why have I done so? Take a minute, pause the video if you need to. Why have I marked this one out? The reason I've done so is because, what did I tell you? Imbalances that form through PXL, PXH are key imbalances, key reference points, and you want to keep them on your chart. So we displace through. Here we see that this PXL, previous 30-minute low, turns into resistance on price, and we continue lower. We see 11 a.m. open up and quickly manipulate. Where? Into a hourly busy. This is the yellow box you see right here. This is our point of interest. Okay? If you zoom in here, we will see something happen at 11:07. Okay? We see the market make a low, and we see it quickly close above this light bulb line. What is it? This is the last lower high before the lower low. So the moment we close above it, we get CST. And what this tells us is that we switch from sell program to buy program. So the SMR gets confirmed at this candle. So this is 11:07, 11:08, 11:09, 11:10. So now this SMR is officially confirmed. Because do you remember what I told you? SMRs is like a cake. It requires a few things in order for us to confirm it. And if you remember what the ingredients were, it was point of interest, SMT, and CST. So we have reached our higher time frame point of interest, this yellow box. We have SMT, which is not written out right here, but we do have SMT with ES on this market. The only thing remaining to confirm this actually being the low is CST. Where is CST? At the previous lower high, the most recent lower high. So, because what I want you to understand is that, Yes, you might look at this one, right? But I want you to zoom in even more. Now we're touching on the advanced things. So zoom in even more. We see a drop lower. We see this tiny green candle, and then we see this wick higher, and then the drop lower. If we go, because this is the 1 minute chart, if we drop into the 15 or 5-second chart, you will see a low, so expansion. We will see a retracement higher and a expansion lower. And this final retracement, which on that time frame would look very clear, here just looks like a wick. So I need you to understand what a wick really represents on the lower time frame. When we are breaking this level, what can we see? First of all, we see a CB right here, an imbalance, okay? Right here, we see a busy, showcasing what? Strength in the market. So we reverse here through the breaker with an imbalance. Notice how I drag it to the right. I extend it, okay? What do we see happen here multiple times? The market keeps referencing this point. It retraces back into it, rejects it. Retraces one more time and one more time, but it keeps rejecting it because this is a key imbalance. From here onwards, we just continue higher. I've noted down this imbalance as well. This is from the left side of the curve. And what did we talk about? The left side of the curve impacts the right side of the curve. We see how price keeps rejecting it here. One time here, almost right there. One more time right there. But what finally happens? Right here, after 12 a.m., we open, goes tiny bit lower, reject the breaker, displays higher. What happens here? Right here, we displace through previous 30-minute high, 11:30 to 12 a.m., right there, with an imbalance. What do we then want to see? And more importantly, this also forms at this imbalance from the left side of the curve. Right there, we see the market close above it, retrace 1-2 candles, reject this level perfectly to continue expanding to the upside. And we can see that how this imbalance, this level that we rejected right there, the moment we displaced above it, closed above it, we saw it act as support on price. Do you see how we are putting every single concept we have talked about together in this example? In every market maker model, everything we have talked about will be found. So now I want us to go into real examples. I want to talk with you through this for a very long time. And I want to make it as clear as possible because market maker models is where everything happens. These are the trades you want to engage with. And if you haven't understood it yet, we want to position ourselves long, either here, here, or here, to target this high. Because we know that when A to B is in, when the SMR is in, drawn liquidity is higher, the magnet is drawing us higher. We need to get to at least this level, okay? This is the beauty. We can, with very high conviction, say that we are going higher. So we want to target or position ourselves long right here. So let's now go into TradingView and to a blank chart to look at this together. All right, so we are now inside TradingView. Let's see if we can find a clear example right here. And what I want us to pay attention to is everything. We'll cover the higher time frame to the lower time frame. So ideally, you will note that the best trades can be found where? They can be found in a trending market, because the only thing we require to have a market maker model is what? Expansion, retracement, expansion. Here we have the market maker model right here. From this retracement, left side of the curve, creating the right side, this is our market maker model. So this will mainly be found on trending markets. Now, how does a trending market look? Right here, we can see that we're clearly drawing lower. And what can we expect when drawn liquidity is lower? Do you remember? This is like a magnet, okay? We know that the market has to go here. We know that, okay? So we can expect that we will keep doing lower lows, lower highs until we reach this level, okay? That is what we need to keep in mind. So let's now find an example where we can see a market maker model. And I will zoom in right here, and I'm paying attention to price in this area. Right here. This is the same price delivery on both markets, okay? Right here, we can see that we are expanding lower, retracing higher, expanding lower. You can see that we are expanding lower, retracing higher, expanding lower. So we know that we have a market maker sell model here. So let's jump into the 1 minute chart and see what we can find. Now, before we do this, now I've played back the price, so I've replayed the chart. We can see that we have our drawn liquidity being right here. This is an obvious liquidity, obvious sell side liquidity that the market has to draw towards. So this is our magnet, okay? This makes lower prices obvious to us. This makes us able to say, okay, we are in fact going lower. And now, if you pay attention to what this low is, because it's not any low, I've marked it out red now, but pay attention. Here we have Monday to Friday, here we have Monday to Thursday. What low do we have here? We actually have the previous week's low. Okay. And why do we say that this is the target? Can you take a guess? I'll mark out the exact same low on ES. Because what we can see right here, I'll mark out one thing. Here we have previous week high, okay? So this is how an analysis is made. We are going from higher time frame all the way to the lower time frame. Here we have the previous week high on ES. What can you see happening right here? Pause the lecture if you need. What can you see happening right there? I hope that you can see this now, because this is the beauty. Right there, we have created SMT in regards to previous week's high. Do you see how ES takes out on Thursday morning, right here at 1 a.m., the previous week's high, whilst at the same time, NQ doesn't? This tells us that we have a purge and revert on the weekly time frame, on the weekly horizon. We have purged, let me write it out clearly, purge previous week high, which means that we have to revert to previous week's low. So we are in a weekly, and this is where it gets fun. We are in a weekly market maker sell model. Look. This is how we can frame even our higher time frame analysis. We are in this move, meaning that we can expect this and this being the SMRs, and every single expansion lower, retracement higher, expansion lower is a smaller market maker sell model inside a bigger market maker sell model. I hope things start to make sense. So let's zoom into the lower time frame, but before we do, I just want you to pay attention to the following. Remember that we always need to have this. We need to have a point of interest, okay? So where would a logical point of interest be? Well, it would be this imbalance on NQ. We can mark it out. Why? Because this is the 7 a.m. What happens at 7 a.m.? At 7 a.m., we open up AM session, the New York session. What candle have I marked out right here? The 4 a.m. candle. This is a candle that signals the low of London. So we displace on the hourly through London low with an imbalance. Do you remember which imbalances I told you to pay attention to? The ones that close through a session or a PXH or PXL. So this is what we can see right here. And then we look at the following. What happens inside here? So let's now zoom into the lower time frame. And right here, we can see the following. And the first thing I want to do before we jump into the first thing we need to pay attention to is where is the market maker model. The market maker model is right here. This one. Do you see it? Left side of the curve, right side of the curve, where this is our what? This is our original consolidation, which we can type out sell side liquidity, because this is where the liquidity is resting. Do you see? Right there. Now, before we look into NQ alone for a bit, what I want you to see is the following. What do we require at an SMR? SMT, point of interest, CST. The first step is point of interest, represented by this. If I delete this, represented by this black line, which is the London low, and this blue shaded box, which is the hourly imbalance, the hourly CB that displays through London low. What is the second thing? SMT. If I ask you to look at this chart for a second, what can you see? Pause the lecture if you need to. What we see right here is a 90-minute cycle, SMT. Okay? Do you see it? ES takes out the previous cycle high, whilst NQ never does. And what happens inside this high? Do you remember what I said is the strongest type of SMT? It's the one that's called double SMT. Okay? What do we see right here? Let's mark out the times of these highs. This is 11:37, sorry, 10:37. Right there. What time did the high form on ES? 10:45. Okay. So what does this mean? That on top of the SMT we have right here, we have a new SMT right there. Because this is the 10:37 high on ES, and it takes it out right there. Do you see it? Right here. This is 10:45. Sorry, this is 10:47. So even a smaller, and now we are getting advanced. I hope you're following along. Here we have 10:45 on NQ. Let me just take off the time cycles. So we have a triple SMT on this high. We have the 90-minute cycle SMT here, right there. We have a 10:37, 10:30, 10:45. Do you understand what this is as well? Because what opens up at 10:40? At 10:40. A new 10-minute cycle. So we have a 10-minute SMT right here. And on the actual SMR on ES, which is this candle on NQ, what happens there? We have an internal 1-minute SMT as well, because this is the candle that NQ even took again. So do you see that now we have the SMT? Let's now focus only on NQ and mark everything out. Mark the things out. So right now we have NQ alone right here. And I will delete these SMT lines, and I will delete this London low. We know it's there. We'll delete it just because we want to make it clean right now. And what do we see? We see original consolidation starting. This is the retracement on the higher time frame. Okay, this is our retracement leg. We then slow down right here. And why do I say this? Because what you'll start to see is that right before the SMR, we slow down. Because the SMR requires a quick manipulation against our idea, in this case higher, tricking and trapping people into believing that in this case we are bullish, we are strong to the upside. So what you see right there is we are slowing down. Now what is this high? It's actually the previous 30-minute high. So 10:30 comes along. 10:30 does what? It opens high aggressively. Now if you have been paying attention, and what we'll do for a second, we'll just take off the time cycles. Okay, what we see right here is where the magic happens. we can look at a few different things. First of all, we see the rejection taking place right there. If we zoom into it, and I will do that with you now, this is very advanced. So this, when you look back at it in the future, you will just smile. What do we see taking place? Now we're on the 5-second chart. Each candle is 5 seconds. What we see is this is the previous 30-minute high. Do you see how clear we are rejecting this level? And then we immediately see a rejection. We purge previous 30-minute high, and this starts the reversal. So if we go back to the 1 minute. So now let's put the time cycles back on, because now we will look at what? The goal of every market maker model when you're looking at these live is to learn to confirm the SMR as quickly as you can. Why do I say this? Because the moment the SMR is in, we know that what is in play. We know that A to B is in play. We know that the expansion on the higher time frame will begin, and we can position ourselves to take part or catch that expansion. Do you understand? We are basically waiting for this whole, because this whole price action, this whole delivery is just an hourly retracement that we are waiting on. We are waiting for this to confirm the point it will reverse, the SMR. And what do we need an SMR to have, or require an SMR to have before we can say that it's the SMR? We need SMT, we need POI, and we need what? CST. What do we already have? Point of interest? Check. The only thing we require is CST. So what you'll start to notice is the way, or what this game really comes down to is determining when CST is in, and how quickly can you determine CST being in. That's when you can enter, because keep in mind, the markets are rigged. The markets are not random. So algorithmically, for the computer, when the SMR is in the code, when the SMR is in, it will never be reached again unless you are completely wrong with your analysis. So this means that we need to learn how quickly can we spot CST. So now we'll progressively look into that, because where is CST? Right here. First of all, I'm asking you, where do you see CST? And I hope that you said that this is where CST is. But the interesting part here is, does this mean we have to wait all the way down here before we can start looking for a short? No, because we'll go over that. But let's first cover this thing, what we see happening right here. Because do you remember the pattern I said to pay attention to? That was an imbalance on the left side, a breaker, which is this candle. So I'll mark out the high and low of this candle right there. This is our breaker, followed by a imbalance on the right. Market structure shift pattern. Okay, why is this important? Well, because this is our latest CST we can determine. But what do we also know? We know that the market will draw lower. We know that we have to form a high in this area. So what can we do? The moment all those SMTs that we looked at just a few minutes ago starts to form, starts to present themselves, we can start hunting for the SMR to form. What does that mean? Well, we can look at it in this way. And now we go back to why I said what I said in chapter 1. The markets are fractal. So this is what it looks like right now. But what did we say? Every straight line, this one, if you zoom in, has what? The exact same pattern. So there will be an internal or a fractal CST happening way before the bigger CST takes place. Do you understand? And does it now make sense why this is so crucial to understand? Because this is what we will do now. We will drop a time frame, or maybe even two, and we will spot the earliest CST. Now, why can we do that? Again, it's because it all comes down to the drawn liquidity. We know that the market has to go lower. Okay? We know that we have a magnet right here. Market markets are drawing towards this. So this is just a pit stop before the bigger drawn liquidity, which is way down here. So we can then start to anticipate things, okay? This is where anticipation comes into play. So let's do this. Now I want us to zoom into this price delivery to see how quickly can we spot CST. Now I just switched right here on the 15-second chart. Remember, this was our final leg. So this is the bigger CST right there, okay? I hope you remember that from the 1-minute chart, bigger CST. But what can we now see right here? First of all, we can see that this is technically a fractal market maker sell model. Funny, right? Because this is an expansion, retracement expansion on a 1-minute chart, which will show us a market maker sell model right here. Something for you to think about. Because what we now see is the following. We pay attention to this. This is our SMR. We know that right here at 10:37. Sorry. We can now write out the expansions, retracements, expansions, retracements, expansion, retracement, expansion, retracement. So where now can you see CST occurring? Pause the video if you need. Right here. Do you see how all of a sudden, and I will delete the red lines, all of a sudden we got a earlier CST in anticipation of us going towards the lower CST, because we know the higher time frame drawn liquidity. We know the higher time frame direction. We know where the magnet is drawing us. And what happens at this low? And guys, keep in mind, this is a random example. This is now the same day that this is a week later. I just found this example. This is the 16th of June. Today, okay, it's 2 weeks ago. Today it's the 29th of July. This is the 16th of July. So guys, this is just a random example. And what do we see right here? Imbalance on the right. Breaker right here. CST line. I will not mark it out. You can see it. This line. How do we close through it? With an imbalance. What do we have right here? We have the market structure shift pattern. And this is when you know you're on side. Okay? So we can now see, okay, right here we confirm the CST taking place. And we can now position ourselves short, targeting this low. So now, where can we enter? And this we'll cover more later. But the moment this has happened, we know that this high, this is the fun part. The moment we get the CST, we know that this red line, if you're right with your idea, will never be reached. It can go here, it can go here, it can even make an equal high. It will never take out this high. That is the beauty. So you can enter short anywhere you want right here. Sorry, that was long. You can go short anywhere you want here. Put your stop above there. You target here. And we have to eventually learn how can we be even quicker. So what can we do you think right here to be even quicker if we want? And now we are very advanced. And this is what I like to talk about. And I hope you're following along. So we write out the exact same things like we did. CST takes place right there. And what was the rule? Every straight line we can zoom into on a lower time frame. So we will zoom into this line from this low to this high and look at it on a 5-second chart. This was the earliest CST on the 15-second chart. Now we're on the 5-second chart. And what do we see right here? We see a new market maker sell model right here. And we can frame a new market maker sell model on the 5-second chart, which is the lower time frame on a 15-second chart, which becomes our higher time frame. So let's now see where we can make CST. Let's see now how aggressive we can be and how early we can decide this, because this is the nature of fractality. Expansion, retracement, expansion, we make a new high, we make a new low there. And then we make a new high right there. And then we make the CST right there. Where is CST right now? All of a sudden, we see CST right there. Boom. And we are even earlier with this move. So let's mark it out properly. Below, right there. And we can now delete this. So now, this is our 5-second CST. And where can we then enter? Well, first of all, what do we see here? We see this imbalance. This low CST gets confirmed right there. Yes, in this case, we don't really see an imbalance getting through here. But that is fine, because this is the CST, okay? We have CST right there. So we can technically enter any time after this candle, 1039, has made CST. So we can just go short right here. And all of a sudden, we have this huge level to target. And now we have a almost 5 risk to reward. That is the precision we'll get. And a 5 risk to reward, we can get even deeper. But this is where I want you to look. And if we again extend this to the left, to the right, we see how price keeps referring to this level. It keeps referring to this breaker right here, because we can mark the whole candle. And we see how price rejects it perfectly, beautifully. Do you see? So now let's get back to the 1-minute chart. And I really hope that it wasn't too complicated. I know that it's a lot, and I know it will be messy, but I need you to see how everything is tying together, how we put every piece we have talked about today into one. And now, remember what we said about time. At 10:30, opens high, boom, takes out this high, rejects it. Everything happens all at once. Everything happens together at the same place when we want it. This confirms it. So we now have the SMR because we have the CST. Either if you want to be slower on the 1 minute, and guys, keep in mind, this is more advanced. This is something you need to practice before you go out there and do and execute on your own. I don't want you to be stupid enough to just think you can trade on the 5 or 15-second chart after watching a video like this. No, you won't even be able to trade the 1 minute. You have to study the 1 minute even more. This will give you all you need. So that is what I need you to understand. So we now know that this is the SMR. And when does it get confirmed? Either here, or either here. So this means that now we know that the market has to draw to this low. Do you see? We know that it has to. Like, it's a fact, it's a must, because this SMR will never be reached. So let's put some lipstick on, and I'll delete the CST lines. Because what we'll see is how the market here creates an imbalance through, if you remember the 5-second, what it looked like. 5-second CST. So we have this happening right there. And this also creates what? Well, this shows that we have strength in the market. We display slower in our favor, showing strength. We can extend that to the right. But we also have, for example, another imbalance forming right there. So we can see how these are in close proximity, and we can find multiple levels. We have the breaker right there as well. Everything is forming in close proximity to each other inside our higher time frame point of interest. So we know this is an important level. And then we see how this was the imbalance on the previous breaker, on the 1 minute breaker. So we can mark this out. And also we see how we keep forming new imbalances in this area. Right here, a CB. We can see here a new BC getting formed. So this tells you immediately this is a big area to monitor. And you don't need to keep all the imbalances on the chart because it can get very messy very quick. Just keep one, ideally from the left. I think that's the easiest to look at. And you know that roughly in these areas, things will happen, right? And then I want us to pay attention to the final thing. What happens when we close through previous cycle low? This can now become your big resistance level. And the moment we close through it, right there, first of all, you see an imbalance through previous 30-minute low right there. You can extend that to the right, but we now see the following. We never close back above previous cycle low. And we eventually, when PM2 opens up, reach our draw on liquidity, our target. So do you understand now how to break down a market maker model? We'll go over one more example because this is so important and we want to go over a market maker buy model. So let's do that now. Let's freshen up and let's get to the next example. Right now we're on the daily time frame and we can of course see ES and we can see NQ right here. What I want us to pay attention to is the following. Now we looked at a lower time frame chart where we usually execute, but I want us to show a bullish example on another time frame. Okay, so this could be, let's say, if you're swing trading, or it could also be if you just want to understand direction, because whatever we do, we can find market maker models. That's the interesting part. So remember what we said. We said that the best moves can be found in trending markets. And I don't know how your eyes work, but in my eyes, this is a super trendy market. Okay, we see that it's clearly going bullish, right? Very clearly. So what I want us to do is focus on an expansion, retracement, expansion, expansion, retracement, expansion. This is the daily. So what will we see if we drop into an hourly chart? We will see an hourly market maker buy model. So let's jump into it. But before we do, we first need to determine our point of interest. And since we are mainly focusing on NQ, we mark out this bullish imbalance, this busy, right? Right here, we can first of all make it a bit clearer. So we replay back to this level. And this is our market maker buy model. Buy side of the curve, sell side of the curve, having our original consolidation, marking out our original consolidation with buy side right there. Same goes for ES. There we go. Buy side of the curve, original consolidation. Let's make a gray box as we know it. Let's make the gray box right there. This is what? This is our left side of the curve. This is what? The right side of the curve. Same goes for ES. Okay. And what can we say that this is? This is the SMR. And what do we see right here? Well, it's a rather messy chart, I would say. And interestingly, the first thing I'm paying attention to is SMT, okay? Because remember, the first thing we always want to learn is how quickly can we spot the SMR. And what we see right here is that actually there's no SMT on this low. You see, this is 10 a.m. and this is 10 a.m. So what I'm immediately looking at, because if you remember from chapter 1, we said that we can also look at the Dow Jones. Looking at the Dow Jones from the same area, from the same time, what do we see taking place? We see that Dow Jones never take out this low. What is this low on NQ? We see that it's all the way down here. So this shows that there's always an SMT. No randomness, no nothing. There's always an SMT. So in this case, we had to pay attention to YM, to the Dow Jones. Let's now jump into NQ alone because we now know there's SMT at this low. So we can now start to look and put our lipstick on. So we know that this is a daily retracement. All of this whole price action is a daily retracement. So what we're trying to do is understand when is the reversal in, when will we reverse to eventually go higher. Okay. So how do we do that? Well, we need to remember the ingredients we have for an SMR because the SMR is the reversal point. So we have point of interest, we have SMT, and we have CST. Great. We have reached our point of interest. Remember what we said? We don't know yet if the point of interest will hold or not. We just wait to see the reaction at the point of interest. So we have reached it. We can now check this off. We make it green. We wait for SMT to start signaling, okay, we will most likely reverse. We get it right there, because remember with YM, we had this SMT. Let's make it very thick so you can't miss it. Here. So now the only thing we have to wait for is CST. So please pause this video, see where you can spot CST. Where is CST taking place? I hope you pause the video because now I'll show you. What we can see is that this is our CST level, confirming to us that we have gone from sell program to buy program. That's confirmed on this candle right there, okay? Right there, not earlier. Why this high? If we mark out the lines, we have low, high, lower low, lower high, lower low, lower high. The next lower low comes there, okay? And then we break it right there. Do you see how we never make CST earlier? We never take or make a higher high, even after there was SMT maybe here with YM. We never took out this high confirming CST. That occurs here, and from here on onwards, we only go higher. That's the beauty of this. Once you see it, it's so simple. It's so objective, and it's so, I don't know, it's just beautiful. So let's take a deeper look at what happens here. Let's delete this, let's delete this. And what I also want to emphasize on is that here, we don't know if this is the SMR, this 10 a.m. candle right there. We don't yet know if this is the SMR or not until we get the CST. So the CST is the final step to confirm the SMR. The CST is the final step that confirms the SMR. So we need to wait for CST. And the CST also confirms that the SMT at the SMR is valid. So that's very important to remember. Let's jump into what happens here. This is our break of structure. What happens at this break of structure? Well, we could say that we have formed this high, first of all, in this tiny CB. It's not in a perfect world, I know, but this is still valid. And let's see if I can just drag it out for us. Right there. Let's make it blue, as you see right there. We have the breaker right here. We can extend this whole candle right there, like this. And another thing here is that, yes, in the breaker, what we said was the break is the final up close candle, right? But what I want you to understand is that if we go into a lower time frame, this will actually be a up close candle. So we can mark this whole level out, right? And how do we break this level? With a busy. So do you see what happens right here? We have the market structure shift pattern. Amazing. So right here, we can say that now from here on onwards, we have to go to this high. We have to close or reach this level, and we will never reach this low ever again until this has happened, because we are programmed now to go from A to B. This is just programmed. This is just in the code. We cannot change the code. And what happens here? Well, order flow switches. And what do we remember about order flow? We now only make higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher than this one, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So this now means that every single, and this is the funny part, within every single retracement here, right here, right here, right here, right here, and right here, and even right here. But this is before we have the CST confirmed. What is all of these red things are written out? It's lower time frame market maker buy models on the lower time frame. So we have expansion retracement, expansion on the hourly, making a 1 minute market maker buy model. Because why? Our draw on liquidity is up here. We know that the market has to draw here. This is our magnet. This is the magnet. Market has to go here. Order flow is bullish. We will never take out the previous low if in fact we are going here. What does this mean? We can wait on every retracement, wait for the exact same signatures, these three, and boom, we can buy. All of these opportunities are buying opportunities. Do you see it? This is the beauty of market maker models. They form within each other, and you want to participate in the market maker models that form in a market maker model that form in another one. That's when you know that it's almost impossible for you to be offside. Do you see? I hope that you start to see how things are happening. And I'm just talking now randomly. So I hope you hear things and see how I connect the dots myself. Because now we can just all of a sudden zoom into any of these ones. Let's just do it. Let's just zoom into this one. Here. We know that the market has to reach this high. So drawn liquidity is higher. We wait for a point of interest. We see this imbalance. Okay, amazing. We then drop into the 1 minute chart. And now we're not paying attention to ES. We just look at this purely because we understand what this does. We can add the time cycles. What do we see? We see the following taking place. We see the left side of the curve. We see the right side of the curve. And boom. Here, the exact same things happen. Time and time again. The exact same thing we wrote out on the bigger time frame happens exactly on the lower time frame. Is this the bigger CST? No, we can zoom in right here, but we will not do that right now because you have to look into this yourself. What I want you to see is that we now can take this market maker buy model right there inside, and now we zoom out big inside this bigger market maker model, bigger market maker buy model, because we are drawing towards this high. So we need to at least reach this high, right? So the retracement here, we just wait for the confirmations, confirming to us that we shift structure from bearish to bullish. And when we do, we go long in this area, targeting this level. So now I want us to go back to this schematic right here. Because by now, I hope you really understand how this actually looks, how we break it down, and how everything is being utilized. The high time frame drawn liquidity, the high time frame point of interest, what we do at each stage, how we confirm the SMR. Because now we'll start talking about the right side of the curve. How do we take trades? Where do we put our stop losses? Where do we take our profits? So let's get into that right now. But before we do, we need to understand that there's a lot of things that we have talked about, right? We have talked about a lot of different terms, a lot of different concepts, a lot of different things, and we need to actually put it into a process, into a step-by-step process, because we can. That's the beauty of the way we trade. We can make it very objective because we base what we do on an algorithm, okay? So why we want to do this is because as a trader, our main job is to perform, is to execute the plan. Because if we don't have a plan to execute, there is already so much stress going on as a trader, so much things to keep in your mind. And I'm sure that by now you can start to understand it. So we need to make sure that we have as much of the process streamlined, objectified, and written down. So we can, in that sense, operate as an algorithm, as a robot, as a programmed figure, whatever you want to call it. Because if we don't have that in place, we will have to manually think about each step. So when the most important step comes, which is the SMR, the entry, and the management of the trade, we will be so tired, we will not know what to do, and we will do different things all the time. Because the truth is, in trading, what it comes down to, and this is not strategy, doesn't matter which strategy you even have. Trading is just math, right? It's just statistics and data. You have a win rate, you have a risk to reward. This gives you either a winning edge or a losing edge. So whatever you want to do is you want to be as consistent to this edge as you possibly can, meaning that each trade, each data point, and each statistic is based on you taking a trade according to a system. So you want to execute this strategy and this process all the time. The moment you start going around it, you take wins or losses outside of your protocol, outside of your system, you start to destroy the data you actually have. So now, before we go into the entries, the stop loss, the take profit, the fun part, the trade management, we first need to look at the protocol, the step-by-step process, and define it. So let's take a look at it, because this means that now we put everything into a full structure. You can say, first I do this, then that, then this, then that, this. There's no like ambiguity, or however you say it, in that sense. There's no guesswork in what you do, when you do what. You know exactly what to do, when to do it, how to do it. So here is the full protocol that we are operating based on every single day, every session, and this is everything we do. If you pay attention to this, this is exactly what we just did. And the protocol, we'll go over it step by step now. Going into each specific point, each section, seeing what it means, how it works, and then we'll look over how we go by it live, right? How we actually operate with it. And as you can see, it's divided into three main sections, right? We have the higher time frame, we have the lower time frame, and the execution part. And we always start from the higher time frame, right? And what I want you to understand is, if you look closely how this protocol is framed, it's always with a yes or with a no question. You can always answer yes or no. And when you can answer yes, you can proceed. When you cannot answer yes, you just cannot proceed. Why this is so important is because if we at the first step or second step cannot proceed, that means we should, if we follow this protocol, never be able to even execute a trade. If we don't have anything clear on the higher time frame, we should never drop into our lower time frame. And the importance with this, why it's so valuable, is because we cannot randomly just end up taking a trade that we should not even look at, because we have the whole process dialed in. So let's go over each step. First of all, we have our correlated / inversely correlated markets in sync. Yes or no? We know, or we now know how this looks, what sync means and how we define it. It's a bit subjective in the sense of does it look good or bad, but with more time, with more experience, you'll clearly within seconds be able to see, okay, yeah, this is actually in sync. If it is in sync, we start to look at, okay, do we have a clear drawn liquidity? Why does liquidity come so early? Take a guess. Pause the video if you need. And the reason drawn liquidity comes so early and is such important is because if you remember when we looked at the whole market maker model framework, right? When we have a clear drawn liquidity, we know that certain things just cannot happen. We know that we have to reach a certain level. And if we don't, that means we shouldn't engage. So if we cannot determine a drawn liquidity, we cannot operate or take any trades, because we will just be in such a mess, both mentally, both in the charts, and we will just feel confused. Okay? Now, once we have a drawn liquidity, we know we're going higher. We have to look at, okay, what is a possible point of interest? So we write it out. Okay, has the point of interest been reached? Yes, no. Remember, we don't know yet if a point of interest will work or not. We have to wait until it gets reached, and then we drop into the lower time frame to confirm if it's actually being rejected, or if we have to look at another one and go back to the point of interest step. The second one is environment recognition. Okay, we'll again cover each step more detailed, but the environment recognition basically means that you have to look at, okay, what is the lower time frame doing? And there's one thing that is called SMT on both sides of the market. When that is present, you don't want to engage, okay? So this basically is very similar to our correlated markets in sync, but we'll get to that later. Second one is your time of interest met? Remember, we are always viewing time before price. Time is more valuable than price. So we have to define, are we in an allowed time window for us to trade? If we are, great, then we just proceed. The third step here is, has CST occurred? Until CST occurs, we don't know yet if the SMR is in, and we don't want to engage, right? Because if you remember, we want to engage the moment we have defined the SMR being in, which comes after we have CST. So once CST is in, we can then look at how does the SMR look, because the SMR gets confirmed after CST. So then the question is it valid? And here are written down double SMT present. Reason being is, ideally we want to have double SMT. If you remember the first example we looked at, it had 3 types of SMT. That's a great sign. So this is something with more time, with more practice, you will have to decide yourself with more backtesting what way or what a valid SMR looks like for you. Personally, I always want to see double SMT, a bigger time cycle SMT, and then ideally a smaller one. That is just what I've found from backtesting, from trading for a long time now, and that's what I recommend. We cover this more later on, and I'll talk a bit about the best or the most high probability ones, what you should focus on, and so on. Once the SMR is valid, now we come to the execution, because now technically we know the MMXM, we know where we are going, we know that the reversal is in, so now we just want to participate in the move. So we first have to define, where are we allowed to enter, okay? Personally, from my own experience, I want to be in the trade as close to the SMR as possible. This means I look for the earliest sign of CST I can find. When I find it, I just enter, okay? That is my personality. That's how I prefer to trade, from a lot of experience. So you have to define, where is your valid earliest entry point, where is your valid, or where is your latest valid entry point. So this will cover, and I'll give you some food for thought, so to say. And the final step is, do we have a valid invalidation level? And we'll get to this, what this means, how we define an invalidation level. But once we have it, we can now execute a trade. So unless all of these steps pass our parameters, we cannot take a trade. And that's the beauty of having an objective, step-by-step approach to the markets. And we can make this as clear, as defined as we want, or as loose as we want. The more defined, the better. The less room for errors you leave. But having a very dialed in protocol means a lot of study, data, and journaling needs to be done in order to know what actually works. So let's start with the first section, the higher time frame. The first question is, are the correlated markets in sync? Yes, no. If you look at ES and NQ, are both making highs and lows at the same time, at the time frame you're looking at. This is crucial, right? The second step is, do you have a valid drawn liquidity? If you don't have one, you just can't move forward, because you don't know what direction price will go. And what I want you to understand here is that when you don't know what direction we're going, so again, we can only go higher, we can go low. When you don't know on the higher scale, on the higher time frame, on the bigger picture, where we are going, the moment you drop into the lower time frame, you will be confused. You will start to pattern trade every single thing we have learned today, because you can drop into the lower time frame and just look at it, and you will see SMT, you will see CST occurring a lot of times. But unless it aligns with the whole picture, with the whole narrative that we are building, you cannot take the trade. You will end up pattern trading a lot, and then you will start doubting the whole things you have learned, or everything you have learned, because you are not trading it appropriately. You're not doing in the right direction, the right order. So that is why drawn liquidity is so crucial. And if you don't have one, you just wait. You stay on the higher time frame and you just wait. Third one is then, do we have a point of interest? Why is this so important? Well, because we have to take the trade from somewhere. Remember, one of the ingredients to an SMR is Do we have the point of interest, or are we in a point of interest? If we aren't in one, we cannot take a trade. So that is just why and when we are allowed to drop into the lower time frame. So until on the hourly chart we have reached the point of interest, we never drop into the 1 minute chart, because our eyes will just be bombed. We will see so many things that we shouldn't look at, rather than just chilling on the hourly chart. So that is something for you as well to remember. So that means that unless all of these three have been green, we have passed each door. You can envision this like doors. If we look here again, envision this like one door, one door, one door, one door. And the answer here gives you the keys to open the door and go to the next. So that is something for you mentally and visually to envision. The second one is obviously the lower time frame. And again, is the environment good on the lower time frame? If SMT on both sides, like I mentioned, is present, that's a big warning sign. Now, what does SMT on both markets mean? Let's show you an example. Let's say right here that we have a market. We have NQ right here. Let's make it a bit smaller. We have NQ right here. And we have ES to the right, okay? Here is the separate time cycles. And we can see how the following has happened. Let me make it a bit clearer to you. Like this, and like this. Okay. So first of all, we see this occurring, okay? And then we see that. On the same time, what we see is this. What we now have is SMT on both sides. So we have SMT on the highs in relation to previous cycle, and we have SMT on the lows in regards to the previous cycle low. Do you see how this is SMT on both sides? Here's the high, here's the low, here's the low, here is the high. This low never gets reached. Oh, sorry, this is the high right here. It gets reached immediately, right? So this is SMT on both sides. This shows you, and again, if you remember how we looked at intermarket relationship, we don't know which market is telling the truth, or in this case, which SMT is telling the truth and which one is lying. Because if you frame a setup on the SMT on the highs, well, yeah, obviously we're going lower. But if you frame it on the lows, obviously we're going higher. So now you're in the middle of it. You don't know. So you want to wait price out, see which one is the real one. How do we know that? Well, we wait until one market catches up. In this case, NQ caught up to this low. So now this SMT is not there anymore. It's only this one on the highs. So now you can just follow the trend. We are now going lower. So that is what environment recognition means. Another thing that is interesting for you to keep in mind, I want you to note this down. This is something with more time behind the charts you will see. When 930 opens up, so let's write 930 up here. What you will sometimes see is 930 being a complete mess, okay? Either NQ goes higher, ES goes lower, or we are just chopping around. Like literally, you will see the ugliest price action you've seen. What I want you to remember, pay attention to, and note down, is that wait until 10 a.m. What you will see is usually this whole delivery will be cleared up by 10. Okay, so note this down and just remember, this is another sign of environment recognition, where you recognize that after 9:30 we open up like a mess. You don't want to engage in this. This is a big no. You wait for at 10 a.m. and then you will see how it clears up. And now we come to the second part, right? Or the second step. Is your time of interest TOI met? Are we currently in a valid time session, time of interest? And this is interesting because this is something you have to decide for yourself, okay? You know the time sessions that we currently have. You know where the best setups will form. Do you prefer trading London? Do you prefer only trading AM? Do you trade multiple session? Do you trade only PM? Whatever you do, based on maybe your schedule, based on your work, whatever. But we have to define what time of interest are you allowed to trade. And you can make it as narrow as you want. You can make it as wide as you want. And I want you to just pay attention to one thing. I want you to pay attention to when is usually price moving. So you have to look at, okay, let's say you're trading PM. The PM1 is usually rather slow. After 1 p.m. you will see how things starts to clear up, starts to open up. And this means that you should maybe say, I'm not trading until 1 p.m. And from 1 p.m. you're active until, let's say, 3:30, maybe even until market closes. This one is a bit subjective, you choose for yourself. What I recommend is to trade, first of all, during London, if you're trading, I recommend waiting for at least 3 a.m. I would even say 3:30 a.m. Wait for 3:30, and from 3:30 you can trade up until 5:30 to 6 a.m. Okay, check these times. When it comes to AM session, do not trade before 9:30 a.m. before the opening, and from opening to 11:30, that is your time window. Okay, so that's a 2-hour window. And from PM, you look at 1 to 1:30, all the way to 3:30. That's at latest I would look during PM. So that is some general rule of thumb, and we can go over this more in depth in another time. But this is the most important, because what we don't want to do is sit behind the charts all day long. Personally, my average chart time a day is roughly an hour on average if we divide it over the week. Sometimes it's 10 minutes, sometimes it's 2 hours, right? Because we don't want to be glued to the charts. You want to get so good at recognizing one specific move, one specific pattern that repeats, let's say, once or twice a week. That's the one you take. That's the one you hunt for. That's what it's about. That's how you become an expert. We don't want to become generalists. You don't want to sit and trade London, AM, PM. Ideally, you choose one session, one window, one model. And when I say one model, everything looks the same, but that's because we are only trading market maker models. That's the basic model, right? So if we, let's say now, are in a valid time of interest, we start looking at the lower time frame on what actually happens. Has CST occurred? When it does, or until it does, we don't know yet if the programs have switched, if the SMR is in. So when CST occurs, that is our confirmation to then now switch from lower to higher or from higher to lower. So that is something for you to note down. I know we went over it very in depth, so I hope it's still in your mind how it works. Then the final question is there SMT? The reason SMT comes later, as I've mentioned, is because it gets confirmed after CST. CST tells us that the SMT is valid and not just a crack in correlation. So that is why it's so important. And again, I've noted down double SMT, right? And as I told you, I will mention some of the best ways to look at SMT, because what you'll find, and I want you to do your own homework on this, I want you to collect your own data on this and decide how you want it to be done. The best setup has a minimum of a 30-minute SMT. Okay, this means that at minimum, you have a 30-minute SMT between NASDAQ and an ES. Why do we say this? Well, because this means that we have purged at least a 30-minute cycle. And that, with time, you will notice how that is stronger than, let's say, if you only look at 10 minutes and so on. But ideally, you also want to see an internal SMT at the SMR. So if you go and paint this out, I'll show you what I mean. So let's say now that we have this on NQ and we do have this on ES. So this is the SMT 30-minute, okay? This means that here we have a 30-minute cycle that opens up. So we have a 30-minute SMT. All right, why is this important? Well, or what do we mean when we say internal SMT? Because this is external SMT, okay? I want you to remember that. This is the bigger SMT. This tells you that unless ES catches up right here, unless ES catches up, we will see a reversal. This is what you can start anticipating and waiting for the moment you see this. Now, what confirms the low in this case? What confirms the real reversal point? Here, all the way here, you know that we'll eventually reverse unless ES catches up, okay? The moment you see an internal SMT within this leg, so from this whole manipulation leg, that tells you that it's now time. Why? Because here is a bigger market maker model, okay? And what is this? This is a smaller market maker model. So we want this one to have an internal SMT ideally in order for us to confirm the reversal on both markets. Okay, this is something I want you to study. Please look into your own charts and see for yourself. You will see what I mean and why I say what I say. So now we move on to the third part, the execution section, right? And this is again, where do we want to enter? This is very subjective. It's up to you. You have to, with time, understand your own personality. How are you as a trader? What do you prefer? Are you more aggressive? Are you more conservative? Do you like risk in a obviously responsible way? Or are you less risk tolerant? Okay? All of these things are personality traits and they affect how we trade as people. I know traders who loves to go short because that's just in their nature. They just feel like if I go short, I go against the masses. I go against people who thinks we only go higher. That's a personality trait. And I know people who only likes to take continuation trades, whilst we like to take reversal trades, right? So this is why the entry stage is very subjective. With time, you will start to see what entry pattern, where in the market you feel like, oh wow, this is obvious to me. So I leave this up to you because you will start to see, oh, the SMR is easy for me to spot. Or you might feel, the SMR is a bit hard for me to spot. I'd rather wait until the SMR is so obvious. And that's your model. Then you know that you wait for, let's say, either the low risk buy or the first stage of accumulation, first stage of distribution. So you wait for the first buying opportunity or selling opportunity, you let it pass and then you engage. So that is just something for you to decide. Personally, as I've mentioned and as I've written down here, I want to be as close to the SMR as I can. How do I do this? I drop into timeframes multiple times. So I have the quickest, earliest CSD on a low time frame and I anticipate the bigger time frame to make CSD after, because I know which moves, reversals I want to be part of, and I've gotten to learn them over time very deeply. The second step is, do you have an invalidation level? Because again, as I mentioned a few minutes ago, trading is just statistics, data, and math, right? You win because you have an edge over the markets, and that edge comes to risk to reward and you making more than you lose. Some strategies do have like 1-to-1s, 1-to-2s, but the way we trade, the way we enter these markets, you will see that you will, I would say, rather easily have 4 or 5 risk to reward rather often, okay? So you have to look at your invalidation level and then compare it to your target. Is it valid according to your risk to reward? Because if you see that your stop loss would be, let's say, 50 points and your target would be 50 points as well, you have a 1-to-1. That might tell you, okay, I should actually risk this, or I should actually skip this trade. Why? Because now you basically make the same you would lose. And that's not a bet you want to take. So then you skip the trade. You fall on the final thing, which isn't bad at all. You have done your analysis correct. It's just that the final step isn't valid to you. And we'll go over how we actually define stop losses in the next part. So just bear with me on that. And the final thing here is that once you have passed all of these things, okay? Once all of these steps have been met, the only job you have to do, your obligation, is to execute the trade and manage it after correctly. Like, you have to just execute it. The button should just be pressed when all the things have been met, because you have one job, and that is to follow your protocol, follow your rules. So the moment everything tells you to do it, you have to just do it. And what you'll start to notice when you start trading now is that you will sometimes have fear to actually execute the trade, or you will be overly aggressive, which means you haven't followed all these steps. But this is what you need to remember, okay? So now let's jump into entries, stop losses, and take profits. How we define them, what we look at, and how we use them. So these 3 things all fall into the category of trade management. So now we have talked about everything up until the point of taking your first trade, right? Now we need to know, first of all, where do we enter the trades? How do we manage the trades we have taken? What do we do when we are inside of the trade? Where do we say that we are done with the trade? Where have we taken the win? Okay, where do we exit the market, take the profit and leave? But where do we say that we are wrong on our idea? Where do we take the loss and just leave? So a few words that we will use is stop loss, which is the invalidation level. This is the level where you will be taken out of your trade and end up with a losing position. Okay? Take profit is the opposite. That's the level where you will be done with the trade, but you were right with your idea and made profits. You made gains. Okay? Trailing stop loss means when you move your invalidation higher or lower in profit or closer to your target. So let's say that you are long. Let's say your entry level is right here. Your stop loss is right here. Initial stop loss. Price is now up here. So you are in this profit, right? What you can do is when price is here, you can drag your stop loss. You can trail it to, let's say, break even. So now you are in a risk-free trade, or you can trail it into profit and you are now making money even if your stop loss gets hit. And we'll of course cover this. We have pyramiding / scaling in, and this is when you add more size, when you add more contracts to an already open position. And then we have partialing / scaling out, which means you take risk, contracts, size, whatever you want to say, off of the open position you have. So let's go over entries, right? Entries of trades can be done at many places in many different ways. The main thing that I want you to understand is this. When the SMR is in, we need to go from A to B. What do you think this means, first of all, when I say this? If you think back to what we have talked about today. When the SMR is in, we need to go from A to B. Pause this video if you want to think some more, because this is very important to understand. What I'm saying here, and what this means, is that the moment the SMR is in, we have to go to your target if you're right with your whole analysis. So if you're right with drawn liquidity, point of interest, and the SMR is actually in, the market will go to your target. Okay? This is just a fact. So this means that if we get to know the SMR, and remember what I said when we talked about higher lows, higher highs, and so on. When we have a drawn liquidity, the market will never take out the SMR. It will never reach it. So this basically tells you that if you can within seconds know that the SMR is in, you can just enter and you will not be taken out because the SMR will be protected. Okay? So that is something for you to think about. Become a specialist, become an expert at knowing and understanding when the SMR is actually in. Okay? Because you will always have the best risk to reward as close to the SMR as possible, meaning the sooner you can enter, the lower and smaller your risk and stop loss size will be, and the bigger your target, right? We always want to make the entry on the retracement. What does this mean? Well, maybe you have noticed now that we want to take the reversals and we can fractalize the market as much as we want. Okay, so we always want to go long on the drop lower, so we are not scared of a black, as I use, or a down close candle. We're not scared to press buy at that one or press short at the up close candle, the green candle. We are not scared of that. Okay, so that is just some small little detail. It won't change too much for you. That's just something to pay attention to. Some entry patterns then, because in the beginning, finding or knowing when the SMR is in is a bit difficult, right? It goes quick, you have to be sharp, we're trading on lower time frames. So we have to look at the patterns that we can use. But I want you to remember this before we go into the patterns. A pattern doesn't mean anything for the sake of it. A pattern only becomes valuable when everything falls into place, when every single thing we have outlined from step 1 to the execution is in play. That's when you know that the pattern will work. Otherwise, we're just pattern trading, and that's not what we are doing, okay? So, some patterns I want you to focus on first is the inverse fair value gap, when we have one on the left that gets inversed with one on the right. That is very strong. We have the MSS, the market structure shift pattern, right? Which is an inversion fair value gap plus a fair value gap on the right plus a breaker inside of it. As we have talked about today, this is the strongest form and the strongest pattern you will see once it aligns with your overall analysis. These are all the patterns that form on all market maker models, as we have looked at, right? You just got to go into the right time frame to see it, because now we have looked at very clear examples. Sometimes what you'll see is that, let's say, the 1 minute chart is just up close candles. That means that you cannot really define where CST lower would take place. So we have to go into that, zoom into that line, zoom into that expansion leg, and see on the lower time frame, we want to see the expansions retracements. That's when you know what time frame to execute on. And as we have talked about the entry time frames, from what we have looked at, from the way we are trading, if we are scalping, day trading, we want to enter on the 5 second, 15, 1 minute. Okay, 1 minute, I want you to start off with and progressively start looking at the 15 and 5 seconds. You don't need 15 and 5 seconds. You absolutely don't. That's just if you want more precision, more or earlier confirmation of SMRs being in play. And as I mentioned, how do you know which time frame to enter off? It's the one where you see expansion, retracements, expansions. Let's now go over a few examples of entries on the chart, how it could look and where we want to position ourselves. So right here we have NQ. This is the date if you want to go into it on your own chart. And we can see the 15-second time frame. These candles all represent 15 seconds in time. We see here that we drop lower, make a lower high, lower low. CST occurs on this candle, right? What occurs right there? We have the breaker forming on a CB to the left. I've marked out 2 CBs that form in a row. You can do that. And then we inverse it with a busy. This is our entry pattern. The moment this happens, CST has confirmed this is now the low. We can enter long and target this. And now this is an example of what I told you right here, that the time frame you have to enter on is based on where you see expansions and retracements the clearest. So here you can see this is a short. This is one chart. This is the same but on a lower time frame. Here is the 1 minute. You see that we are just going higher right here. CST on here would be all the way down there. But on the 15, what do we see right here? We see expansion, retracement, expansion, retracement, expansion, retracement, expansion. So now all of a sudden CST is there, which is a wick on the 1 minute. So we can clearer see this right here. And here we see the market structure shift pattern. We see busy, we see the breaker, we see the CB form through the inversion fair value gap. And we enter the moment this happens. So on the pullback, right there, you go short, boom. And some final notes when it comes to the entries, because it's usually a repetitive pattern, yes. But the moment you know that the SMR is in, you can enter anywhere because price won't go below or above that SMR, just like I told you before. And this is super important to understand, because this means that your focus will eventually, with more time, with more experience, switch from finding entry patterns, and I hate the word entry patterns. It will go from finding entry patterns to just recognizing when the SMR is in. And this is time, a lot of backtesting, a lot of hours on the charts to see, because this will eventually become intuition. You will start to feel when the SMR is in. Obviously, you don't want to act on the feeling alone, but this gets added as a confluence. So the best way to learn how and where to look is to do the following. First of all, you look on people that you like, traders that you like, that trade this way on X. I recommend X or Twitter, whatever you want to call it, and look at their executions, their entries. You can look at mine, you can look at other traders that you like. And what you then do is you open the exact same chart on your computer and look at the details of why they entered where they entered. Okay? So you will have to really zoom in, because there you have proof. They actually took that trade. You just have to reverse engineer and understand why. I recommend look at least 50 market maker model examples and see when and how soon you could confirm the SMR to make the entry, right? What do they all have in common? Because you will see that every one of them has something in common. And this basically tells you now that you can start to look at these examples, but what I want you to know is you will have to play with the time frames, experiment, see, oh, might it be this? And now you look at 10 more examples. Okay, it wasn't actually that. It's this, etc. So this will come with more eyes or with more time. And once your eyes are trained to this, that's when you will understand what I mean, and you will just smile listening back to this. Now we move on from entries to invalidations, right? So where are you wrong in the market? Because we have to say a level where we are wrong. Otherwise, what will happen is if we cannot accept being wrong in a trade, we will blow our accounts the moment it goes against our favor, because we have no stop, right? So this is basically like a brake on the car. If you just had a car that could drive forward, eventually when you need to stop, you couldn't, you will just crash and whatever happens there would happen, right? So first of all, we have to mentally understand and accept that being wrong in a trade means absolutely nothing. Because winning in trading is only determined the moment you enter a trade that followed your whole protocol. The outcome of the trade doesn't matter. Why do I say this? Because we know that trading is a game of probabilities. We know that trading is a game where losses are inevitable, like they are guaranteed, literally guaranteed, okay? So us being emotional about something that's guaranteed doesn't really make sense, right? So we have to mentally accept this and mentally rewire what we focus on. The focus is on the input rather than the output. Let's now actually get into how we decide and determine stop losses, right? Because our stop loss is always at the most recent protected swing, followed by CST. Okay, I'll read it again. Our stop loss is always at the most recent protected swing, swing high or swing low, followed by CST. Every new swing point that has SMT followed by CST becomes our new invalidation. So we can trail the stop loss to that level, and we'll get into that later. Let's take a look at a few examples. Here we have a market maker buy model on the 1 minute time frame, and we can see that right here we got the CST, okay? Low, high, technically we actually have CST right there, but on the 1 minute, this one is a bit cleaner, right? So what we see is that we have SMT right there. Do you see that it says daily SMT with ES? I hope you can see it. And there's a 30-minute SMT with ES here as well. This is our what? Our stop loss is always at the most recent protected swing. And new swing point that has SMT is a protected low. So this means that right now our most recent protected low, which means our most recent low that has SMT after we have gotten CST higher again, is where we put our stop. So what you can see is we put our entry right here on the retracement back into the range, into this level, stop loss below the SMR in this case. Let's take a look at another example. Here, I haven't written out the entry, or I've written out the entry, but I haven't put out the risk reward tool, the position tool, okay? The question I want you to think about is, where should the first stop loss be? We have been going higher. This is a market maker sell model, and we have made the high right here. We enter the trade short right here. We have a session SMT at this high. Where do we place our stop loss? Entries here, stop loss, Entry is here, SMR with SMT is right here. Okay, so pause the video if you haven't yet, and let's take a look right now. Right there. So now we have zoomed in to the exact same delivery, just a bit zoomed in. We enter the trade right there. We put our stop loss above the SMR. Why? Because that's the most recent high with SMT after CST. So CST on a lower time frame will be here, but also here, and this makes the most recent high. And now let's look at something else, because now price has kept going in our favor, right? Price has moved in our direction. So now price is down here. On this candle has closed. We are down here. This was our initial stop loss. As you can see, first SMR, or the SMR first invalidation. We went lower, went higher, retraced higher. We have, as you can see right there, a small SMT with this red line. We then made CST on this fractal market maker sell model. So price is now here. Where should our stop loss be now? Where is our most, if we read this again, where is our most recent swing point that has SMT followed by CST? Right there. So take a look at this, pause the video if you need to. Where should our stop loss be now? Should it stay here or should it move? The answer is that the new trail stop loss is now above this high. Price is here, stop loss is now moved here. Why? Do you see how this market made CST or expanded lower before or below this fractal market maker sell model? And what do we see on the SMR of this market maker sell model? We see a SMT with these two candles, this red line. So after we made a new lower low, being this low, and the lower high, being this high, had SMT, we can trail our stop loss to this high, because this becomes our new protected high, our new invalidation level. So now let's go over take profit, right? And this is the most simple and objective one out of all of them. We always target the original consolidation of the market maker model as our target. This is our first target, and we never take anything off the position unless a few things show that we'll get to later. The second target is always the drawn liquidity we have, which we know is beyond the original consolidation. Because if you remember the schematic of the market maker model, we have, let's say for a bullish example, we have drawn liquidity, we have original consolidation. So this means we trade from here, we know we are going here. So our first target is this level, and then we wait for this level, right? So this is very simple, always the original consolidation. Here's an example. You trade this market maker buy model, drawn liquidity is up here, okay? You enter long right there, first target is the original consolidation. You could, and this comes down to preference again, you could frame this one as a fractal market maker buy model, take something off here. That is completely up to how you view it, what your personality or what your preference is. So you could say, yeah, we're trading this bigger market maker buy model, here we have a fractal one, and you can take first target right there, second one right there. So you don't need to take the full position off. Here's another example. And now I want you to think, this is a market maker sell model, okay? We enter the position right there after CST. Here is the SMR, we have our stop loss placed right there. Where is our take profit? Where is the target? This is the original consolidation, left side of the curve, SMR, right side of the curve. I hope you paused, because now I'll show you the answer. The full target is right there, or the first target is right there. Why? Because we are trading this market maker sell model. We know that we are drawing below and lower than the original consolidation. So we know that our first target is at least this low. So now let's jump into pyramiding. What and how we scale into positions, how we add size when our stop loss gets trailed. That's the magic. Because pyramiding is the art of adding more size to a position at the same time as we take more risk off the table. Which sounds amazing, right? And it is when you're doing it right. This is when you have the big trades, the home run. What I want you to understand is that when we are in a trade, it goes in our favor, right? When it goes in our favor, as well as the market makes new invalidations, right? We make new retracements that has SMT, which then becomes protected lows or highs. This gives us new invalidations, right? We can trail our stop loss. And what a trailing of stop loss does, it is minimize the risk we have on the table. And then we can add new size. We can add to the position that we just cut risk off. Do you understand? So we can basically now add more whilst still minimizing the risk we have on the table, because the market has told us that we should never reach a new high or low. If we do, we are wrong with the idea, and we can then add more until we get to the level we want to get to. So an example here, right? You enter first, right here. You risk $500, right? And it's a 4-to-1 risk to reward. You would make $2,000. Here's the first entry if you look down to the right. The market moves higher, as we see right here, okay? And makes a new invalidation. So we first makes a high, lower high, higher high, okay? Higher low, sorry. So high, higher low, higher high, okay? This higher low has SMT, and we have made CST on this fractal market maker buy model. So this is our new invalidation level. We can now trail our stop loss to this low, and it only has $250 in risk. So now if the market reaches this level, we only lose $250 compared to our initial $500, okay? This means that we can now add this next retracement pyramid. We can add to it. Why? Because we have already taken off half the position, so we can add slightly more, and we are still risking less than what we started off with. So now you can add 150 in risk. So now, rather than this being 250, we would now lose 400 if the market reaches this low. But now, all of a sudden, since we added to the position, rather than only making 2,000, we would make 2,900, okay? And now the market keeps moving. We make a new higher high. And where we made the second entry, so the first pyramid, we now have a new invalidation, a new SMT on this low. What this means is we can now, right here on this retracement, pyramid again. Because right now, here, our stop loss would be plus 100. So if market goes here, we would still make money. This means that we can now pyramid at the third add right here, an extra $100 risks compared to here. So we are now plus minus zero. We are in a risk-free trade, but since we have added to the position, we would make $3,500 if it goes to the target. So we almost 2x'd our outcome whilst minimizing our risk on the table and ending up at a no risk on the table. So basically, if we were to be wrong, we would end up plus minus zero. No lost money, no won money. Let's take a look at a real chart example, how this could actually look. So right here, we can see a market maker buy model, okay? Here we have the left side of the curve, SMR, right here. And here we have the buy side of the curve. Entry is done right here on the red circle after the first CST, okay? We make CST right here. And what we see after this is market goes in our favor. Our stop loss is, by the way, right here because the SMR is our most recent protected low. So we cannot do much about it. Stop loss is here, entry is here. Market goes in our favor, okay? Market eventually retraces deep. So now we are in drawdown. Keep in mind, we entered right here. So we are now in a drawdown. Our stop loss is still down here. And what we now see is the following. we continue higher. We make a new CST right there. Okay, so we can now pyramid right there at the same time that we got new SMT right here and can trail our stop loss. Do you see? So we have trailed the stop loss from the SMR to this low risk buy because this has SMT and we have now gotten CST. So we can pyramid and minimize risk. Market continues in our favor. We retrace once again, stop loss is down here, remember? And we then get a new CST. Why? Because this is a fractal market maker buy model. Here we have the breaker, low, higher high. We break structure. We can now pyramid right there again because we can trail our stop loss here to this high. And we are now risk free because we initially entered down here. So from this position, we are in profits. From this, we are slightly in drawdown, and from this, we're in drawdown, but we always pyramid less. So let's say you start with 3 contracts, you pyramid with 2 and then with 1. Markets eventually continues, right? Here we make a new high, a new low, but this time there's no SMT on this low. So we cannot pyramid or we cannot trail a stop. This isn't a protected low. Instead, we continue higher, stop loss is still at this low, retrace once again, and here we have a new SMT, right? So when we make CST right there, we can now enter. You can enter there or you wait for this retracement that in this time came. Sometimes it doesn't come like this. It's not that usual. So you then just keep it or you enter right here. Stop loss is here. So now all of your first 3 entry points are in profit. Only the 4th is in drawdown. But since we pyramid downwards, you will have a winning trade if it takes this low. We eventually move sideways for a bit, retrace back into this inverse fair value gap, never reaches the protected low, and then the market goes in our direction. I hope this makes some sense and I hope you can start to see how it works. So let's now start talking about partial. This is the opposite of pyramiding. Instead of adding to a position, we subtract from our position. And there are only 2 times when we ever would do this. First of all, when we have intermarket relationship tell us to, or number 2, when our first target is reached and we leave a runner. So if you're trading Nasdaq, right, and ES reaches the original consolidation before Nasdaq does, you take a partial, right? So this is the first example. This is because this could create SMT on opposing side of our direction, and we don't want to end up in a new reversal to the downside or upside, basically against our direction. The other example, if you're trading ES and NQ reaches the original consolidation before ES, you take a partial. Why? Because if you remember, I think as well in chapter 1 or chapter 2, when we talked about intermarket relationship, might even be chapter 3, what we talked about was that we want to monitor the reactions to the highs and lows, the same ones, because we will see that sometimes that creates a new SMT and we get reversed that. So we always want to secure some profit when that happens. Let's look at an example, right? We have NQ to the left, we have ES to the right. This is a market maker buy model. As you can see, SMT right here, we go long, somewhere here, stop loss there. Target is original consolidation to the left. What do we see happen at 10:09? 10:09 right there on NQ, 10:09 right there at ES. The moment ES takes this out, we have to take a partial on NQ because it's lagging behind, and this could create SMT against us and roll over, meaning go lower. So let's see what happened. This is the same chart, a bit zoomed out. 10:08, 10:08. We see the market never reaches the original consolidation and we never reach our target. So in this case, we made money. We can trail our stop loss to at minimum break even here because this is the likelihood that could happen. And we see price doing exactly that, rolling over. So this is when you want to take partials, right? So what we will do now is together we look at one of my trades that I've taken. We will look at an execution and see how I manage it. All the pieces together, right? I want you to look at the same one on your chart, so have it next to you and we'll walk through it together. And this is what I want you to do alone as well. I want you to do this on many examples because The best way to learn is to see how people you like, traders you like, see how they manage their trades, because learning by doing is my favorite saying, my favorite way of learning. I can tell you everything I know, but you will still not learn fully until you have done it yourself. So right here we are on my Twitter, right, on my X. So let's jump into a trade that I took and let's monitor what happened. So let's take right here we have a trade that I took, and this is from the, let's check, this is from the 10th of July, right? So let's monitor what I do, where I enter, and I want you to pull this up on your own chart. It's the micro contract of 2026. So let's monitor it. What we can see is I enter short right there at around, I think it's 10:04. Stop loss is above the SMR, right? So let's see what happens. This is a good one. Right there I mark out a low, which I monitor the reaction to. And there I did indeed trade my stop, but I did it as a mistake. I put it back here because we have not gotten CST on both markets, and I don't see why the SMR, or we haven't basically gotten a new invalidation level. So this is still our invalidation. So whatever happens, happens. Remember what I said, when the SMR is in, it will never be reached. You can see we come close, very close to it, but we never reach it. Let's look at what happens. Still, there's no new invalidation level, so we keep our stop loss just where it is at the SMR. And price keeps hovering around at my entry point, and as you can see, I typed out here slowest trade I've been in. It was a very slow trade, I must say, but this is what happens. The best trades, what you notice is they will just run in your target immediately, just like this. What you'll see is we'll reverse here again, but the best trades just shoots in your direction. But in this case, it was a very slow one, and this can happen, but your job is to do the exact same that you should all the time. Just do and follow the protocol. And you see, I keep my stop loss right here because there's still no new invalidation level. So let's monitor what happens. As you can see, I marked out here the previous 10-minute low. I wanted to see it act as resistance on price. It never did. We came above it. Here I've marked out an imbalance, paying attention to the reaction inside of it. Ideally, we wanted to reject this area. We didn't. We went above, and now something crazy will happen. This was a news event. Markets just tanked. You can see that we went like 200 points in literally 1 minute. So this was, I wouldn't say luck, because the thing is, once the SMR is in, the SMR is in. They can manipulate however they want, and this is what happens. They will manipulate price in your direction. So I want you to look at an example like this, and here you can find on my X other trades that I've taken where I want you to pay attention to how I manage those trades as well. Now we have come to the stage where we know how to enter trades, how to analyze the markets, and how to behave or how to manage trades we are in. Now it comes down to the final part, and this is crucial, right? This is called risk management. This is basically how we manage risk, because at the end of the day, trading is only about managing capital, managing and preserving capital. Trading is not about making money, rather it's about preserving capital in a controlled way. And there are 3 different scenarios on how we actually handle risk management based on how we trade, or based on what we trade. So there is something called prop firm challenges, prop firm accounts, okay? These are more importantly the challenge account that I'm paying attention to. We have the prop firm funded accounts. So that's a funded account. We have live money personal accounts, and we approach all of these 3 differently because they work differently, right? Because they don't have the same objective that we're trying to do with them. So the first is the prop firm challenge. This can also be called an evaluation phase. What this is when you buy a account at a prop firm and they want to evaluate if you know how to trade. You will have an account, a simulated account, that you will have to meet a certain amount of requirements, rules, in order to pass and get to the funded stage where you can get paid. And this stage, you want to pass as quickly as possible. And this is one of the biggest mistakes traders make. They think that they should be careful in this stage, that they should risk very low and manage the account properly, right? And they get they get stuck in something called the eval jail. You want to risk as much as you are possibly allowed to risk on the account. So this means that you have to treat one eval, one challenge account as one trade. You can either win it or lose it. A win means that you pass your account, and a loss means that you blow the account, so you have to buy a new. You never want to take very small risk trades and stay on the accounts for weeks for no reason. Because the thing you have to understand is that at the eval stage, you can literally make no money. You cannot make anything. The eval is just like a gate for you to actually make money. So you want to jump over the gate as quickly as you can. So this is the first thing you need to remember. When we get to the funded account, usually you will have a 4% drawdown limit and some sort of minimum trades that you need to take. Each account, each business, each prop firm is different in the rules. So you need to really look at your own rules, right? You need to risk 10 to 15% of the drawdown you have per trade at max. So let's say you have a 50K account, $50,000 account. In reality, you might only have a $2,000 account because your drawdown is only 2,000. When 2,000 is reached, that account is blown. So you don't really have a 50K account. That's just what they tell you. And this means that you can only risk 10 to 15% of what? Of the 2K. And this way you also use a move or a moving size, a risk that keeps going up or down based on your drawdown. Let's say that your drawdown is 2K. You have a fresh account, then you risk between $200 to $300. But let's say that you are now deep in drawdown. You have only $1,000 to play with. You can now only risk $100 to $150, right? And you also have to pay attention to the rules, as I mentioned, on each account, because there's something called the consistency rule, which is very important. It's very different on each account. Some do have it, some don't. If you have it, you need to look at how it works. Basically, what it's saying is that your biggest trading day, biggest win cannot exceed a certain percentage of your total gains on the account. So you have to calculate each trade, okay? And what I want you mentally to remember is that funded trading is a compound game, okay? This takes slower in the beginning, and in the beginning you will not make huge money, right? The one you see on social media, the 5 figures, 6 figures. You will not make that in the beginning. The goal is to scale your account. So you have 5, 10, 20, 30 accounts that you copy trade. Copy trading means when you take one trade on one account and they all copy into the other accounts. So that means that a small 1K payout on one account that might take you 2 months in the beginning to get will eventually become a 20K payout in the same time span because you copy the amount of accounts you are trading on. You do the same input, but you have scaled and compounded how many accounts you have. So that is what I need you to remember. Don't rush the funded stage. Let it take the time it needs to take because the goal is to compound over time, and then you will have the leverage you want. The final thing is when you trade your personal account, your own capital. And the most important thing here is to risk an amount that you can trade properly based on. Because what you'll note is that if you risk too much, you will not be able to enter the trades you should, the way you should. Remember the protocol we outlined before. You will not be able to follow it as precisely because there are too many emotions because you're risking too much money. The amount you would lose if you were wrong is basically too much to what you can tolerate. So you have to manage that. Okay. And you will not, if you end up taking a trade that is too much risk, you will not be able to handle and manage the trade the way you should. Okay, so too high risk leads to you easier revenge trading, easier going on tilt, because the money you lost becomes personal rather than just you taking a bet. So start small and slowly scale. The best is when you can take a trade without even caring if you lose it. That means that you are risking a good amount, and with time you slowly scale up. So now we're approaching the end of chapter 4. What I want you to do is only now do the following. I want you to pick 50 market maker model examples. This means a hourly expansion retracement expansion, up and down. And then you go into the 1 minute and mark out all the things you can see and have learned from it. Mark out as much as you can see, right? Because the thing here is that this means now that you will do the same that we did a few, maybe 1-2 hours ago in chapter 4, or in the beginning of chapter 4, when we looked at the models together. That's what you will do now, to keep practicing your eye. Keep seeing where's the earliest CST, and the more detailed work you put in, the better results you'll get. Okay? So find the second exercise, the second homework is to find 10 trade executions from my Twitter and have your chart open right next to it, right? And then I want you to follow along. The moment I do something, check on your chart what I did, why I did it. Pause and take notes every time you see something. Mark out everything I mark out and pay attention to every trailing or management I do in my trades. Why I enter, where I enter, and so on. Okay? So this is the end of chapter 4. And now you should know, I see I've written down So now you should know the following. What a market maker model is, and that every single market maker move is a market maker model. So every single move in the market can be viewed as a market maker model, depending on the time frame you look at. I want you to understand how we step by step go about our trading with the protocol we created, with the protocol and step-by-step process we have. You should also now understand how to enter a trade, where and how we place our stop losses, where we take profits on our trades, and how we manage the trade when we are in it, okay? And the final thing is you now understand the basics of prop firms, how they work, and how we strategize our risk management on the accounts based on challenge/evaluation phase versus the funded stage. So now we come to the final chapter. What now? What do you do now? You have now gotten all the information you need in order to actually trade profitably, okay? Now it's about practicing this knowledge and making it a skill. Right now, you don't have the skill of trading yet. You have the information and you need to practice it so it becomes a skill. And I'm super big on learning by doing, okay? That is how I've always done my whole life and how I always do when I learn something new. I rather go out and start trading, and I rather you go out and start trading demo money. I never advise any real trading when you feel at 70% than waiting until you feel at 100%. Because you will always be able to feel like, I can know this, I'm not yet there. There's something more I can learn. There will always be something else, right? So that is why you fail forward. That's one of my favorite sayings. Fail forward, constantly fail forward in trading, in life, in anything you do, okay? Just go out there. The two ways I want you to practice now is, first of all, backtesting, like by using a backtesting software to speed up the process. Because the thing is, like in trading, which is very different to other things we do in life, is the more hours we put in doesn't help. The more time we sit actually trade doesn't help. It will just, what you will realize is it will just do worse, right? We can study more, but we cannot actively trade more. That's why you need to use backtesting softwares to speed up the process, because then you can basically trade weeks, months, years of data in hours, okay? And an example of this could be TradeZella. It could also be FX Replay. That's the one I personally have used a lot, FX Replay. So I know I have no relationship with them or so on. That's just the one I've used during my journey. The second way is to demo trade live and journal each trade. And I want you to make daily and weekly reviews of your performance, of your feelings, of your thoughts, so you can look back and actually see your progressions, right? Because after some time, when you start feeling like you now know what you're doing and what you're looking for, you should then buy your first eval account, okay? Study as much as you can, because your eyes should be able to talk to the charts, like I said in the beginning, and read them like it's your first language. A few seconds of looking at a chart and you should immediately be able to see, this is what's going on. This is what's gonna happen, or right now it's terrible. I have nothing to do. So, if you're still here, well done. You're in the top 1%, or I would even guess the top 0.1% of the people who clicked the video. You now have every concept you need. And I hope that by now you understand the whole A to Z of how we approach the market, how we read the markets. But let me be honest with you one last time. Because as I mentioned, if you remember the first thing I said in the video, it took me 4 years to get my first profitable month. It wasn't because the knowledge was hard. Trading is not really a knowledge problem. It's a mental problem. It's about execution. It's about discipline. And it's about consistency. That's the part I would say no video can do for you. And there are two parts from here. Path 1 is that you take everything in this video, you backtest it, you journal it, and you do everything on your own. You build it on your own. Because everything you have learned and everything we have talked about today is literally everything you need. You just got to study everything until it becomes second nature for you, until it becomes your first language. Path 2 is that you do everything together with me, one-to-one. We have weekly calls. You get feedback on everything you do, your homework, your questions, your trades, your performances. And you have someone holding you accountable to the goals we set out that you and I want you to achieve, and making sure that you are held accountable until this goal is reached. That's exactly what Alex did. That is exactly what Jacob did. And I only work with a few traders at a time to make sure that we can work as effectively, as properly together, and as much time from my side that I can put into each student. So if you want a spot, you can send me a DM on my Instagram that's linked in the description of this video. And if you want to see what this actually looks like, at the end screen, right somewhere right here, you can find the interview I had with Alex, one of my students, where you can hear him talk about the journey, what he liked, what he found hard, and his ups and downs. So make sure you press it. And until next time, I believe in you. Keep going and peace out.